Ladies and gentlemen, a very good morning to all of you, and I'm Vince, your MC of the day. We are honored to have you being part of a meaningful live webinar as well as panel discussions today. With the well-known Pareto principle of 80 to 20 rules, our team is always aiming to identify the most important 20% factors that impacts the general tendency of the market performance. Without further ado, let's kickstart today's agenda. Firstly, we'll be having Mr. Jason Wong, the research manager of SFM1 Malaysia, to share with us his current view on the market outlooks of the second half of the year, and to latest recommended unit trust list as well as our selections methodology. Secondly, we're also inviting Mr. Jelly Lee, the FSM1 portfolio manager, to present the current portfolio construction methodology of SFM1 managed portfolio, as well as to share his view on the performance of the portfolio during the pandemic sell-off last year and the market rebound in the second half of 2020. And on top of that, he will also be sharing on the current portfolio strategy given the current market conditions. So lastly, we're having an interactive panel discussions by SFM1 regional research teams. In these sections, the team will consolidate information and share with you the investment idea and the key areas on which markets are attractive for the rest of 2021. So before we starting our very first sections of the day, please allow me to introduce Mr. Jason to you all. Mr. Jason graduated from the Australian National University with a double degree in actuarial study and commerce, majoring in accounting and finance. He is also a CFA chartered holder. On top of that, he has almost 10 years of experience in various finance and investment related roles. And currently, he is responsible for overseeing the Malaysia research team, which cover the Malaysia, Thailand, and Indonesia markets and investment products domiciled in Malaysia. So without further ado, please welcome Mr. Jason Wong Jia-jun. Jason, the floor is yours.
Good morning, everyone. I'm here today to help you answer some of the budding questions that you may have in your minds. After you've seen the recent market rally, some of you may be wondering, is it too late to enter? Is there still upside for markets? And finally, how do we select our recommended funds? So let's move on. Before we start, please take a moment to go through our disclaimer. Let's move on. In today's agenda, I'll be firstly sharing with you a review of our 2021 investment calls. How did they do? Were there more hits or more misses? Then I'll also explain some of the key investment themes going into the second half of 2021, and also our recommended funds methodology, how we select the recommended funds. And finally, if we have time, I'll open up the floor for some Q&A. Firstly, at the start of the year, I was sitting here. Some of you may have attended the webinar where I laid down 6 key investment themes for 2021. And so far, you can say that we have done pretty okay with 5 out of 6 calls correct so far. Firstly, in terms of inter-asset allocation, we favored risk assets, i.e. we recommended investors overweight equities over bonds. And so far, it has not disappointed, with the MSCI World representing global equities up 15%, whereas the Bloomberg Barclays Global Aggregate Bond Index, which represents global bonds, are down 3.2%. So I'll call that a hit. Our funds that are related to global equities have also done pretty well, as you can see. In terms of intra-asset allocation within equities, we favored Asia and EM over developed markets. And you can see that Asia and EM, they are slightly underperformed compared to the global equities. In fact, Asia and EM were ahead of global equities at the start of the year, okay, before the market retracement that we saw at the end of first quarter. Okay, subsequently, the global equities, they caught up and overtaken Asia and EM equities. But we believe that by the end of the year, okay, Asia and EM would catch up to global equities. So far, we have gotten this wrong, but we believe there's still another half year to go. We will see. Okay, even though Asia and EM they underperform, you can say underperform compared to global equities, but nevertheless they're still positive. They have produced positive returns, and the funds that are related to Asia and EM have done pretty well as well. Thirdly, our favorite markets that we laid down, we stated that we like China, Korea, Taiwan, Indonesia, and Brazil. And so far, they have not disappointed. Most of them are in positive territory, and the funds that are related to them are also positive. So I'll call that a hit as well. Number 4, we highlighted COVID-19 driven digitalization and healthcare innovation, which would be beneficial to the digital economy and also healthcare sector. And so far, as you can see, the Nasdaq 100, the tech-heavy Nasdaq is up 16%, whereas the MSCI All Country World Healthcare Index is up 10%. And similarly, the funds related to these sectors have also performed well. In terms of intra-asset allocation within bonds, for Malaysian investors, our core bond portfolio will be Malaysian bonds. We advise that Malaysian bond investors stay within a short to medium duration range, okay, and look at opportunities within lower and unrated credit. And so far, this has been correct. As you can see, the ABF Malaysia Bond Index Fund dropped 5% during this the first half of the year. Okay, whereas funds that were more short, medium duration and held lower rated or unrated securities, okay, with a lower credit rating in terms of their portfolio, did relatively well. And lastly, we also saw value within Asian high yield and also EM bonds. Okay, and so far, Asia EM bonds, Asia high yield and EM bonds have outperformed global bonds. So I'll call that a hit as well. Next, markets have rallied so much. Is it too late? Is there still upside for the market? Some of you may have these questions in your minds. Our answers are no and yes, respectively. I'll try to explain more now. We believe that going forward in second half of the year, the key investment themes are still mostly intact. In terms of intra-asset allocation, we still favor risk assets, i.e. overweight equities over bonds. In terms of intra-asset allocation within equities, we still favor Asia and EM. Our favorite markets, China, Korea, Taiwan, Indonesia, and Brazil. Digital economy and healthcare. And in terms of intra-asset allocation within bonds, for Malaysian bonds, the core bond portfolio for investors in Malaysia, we advise switching into more medium to long duration bonds. I'll explain more of this later, and also continue to seek opportunity within lower unrated credit. And lastly, we see value in Asian high yield and emerging market bonds. Today, I'll mainly go through, okay, because of the constraints of time, number 1, number 2, number 3, and number 5. Firstly, we favor risk assets, i.e. overweight equities over bonds. So if we look at this chart here, basically what we're trying to say is the global economy is in a U-shaped recovery. And the U-shape, it depends on the region, depends how fast they get their vaccination completed. So we can see that in Western countries, US, and Western Europe, okay, the developed countries, they have done a much better job in terms of vaccination. Okay, their vaccination rates are much higher, and because of that, they are opening their economies much faster compared to a lot of Asian and EM countries. Okay, therefore their U-shape is much earlier compared to Asian and EM economies. Okay, and this is just the start. Okay, we believe that Asia and EM will definitely catch up later. I'll explain more later on. Okay, in Bloomberg, okay, there's actually a Bloomberg vaccination tracker which tracks the vaccination rate of countries around the world, and it's very useful. You can see here, okay, the more green, the greener the country is, that means the higher the vaccination rate. Okay, and you can see very clearly that countries like US, Western Europe, China, these places, their vaccination rates are much higher compared to a lot of the lighter colored regions. Okay, so overall, more than 3.5 billion doses have been administered, okay, enough to vaccinate 23% of global population. And at the latest rate of about 31 million doses a day, you take another 8 months to cover 75% of global population, which is the number that a lot of experts think that this will achieve herd immunity. Okay, 75%. And 8 months is not too far away. Okay, if you think positively, it's not too far away. In terms of the rate, it is also increasing. The vaccination rate is increasing because more and more vaccines are being introduced, more and more are being produced by new manufacturers as well. They are coming to market, like your Sinovac, Sinopharm, and so on. Pfizer, Moderna, a lot of vaccines. Okay, so this actually helped to speed up the vaccination rate globally. And you can see that countries that have already had high vaccination rates are opening up the economies. For example, like in US, they actually allow fully vaccinated people to go out without masks. So they can just go out in the US. And if you have watched the Euros, okay, the Euros have stadiums full of people, okay, in Europe, because most of them are already vaccinated. So these are the scenes that we are seeing, that the economies are getting closer and closer to normalcy. And this improving situation will boost sentiment, boost investment sentiment, boost risk-taking sentiment as well. The next question is, do vaccines actually work? So to answer these questions, let's look at some of the statistics. And we focus on the countries that were really, really badly hit at one time. If you remember the US, they were quite serious in the US in terms of the COVID cases. Okay, so the US, in the top left hand side, okay, you can see that gradually since the start of the year, they have been vaccinating people. Currently, they have about 52% of people fully which are covered. Okay, and their number of cases have dropped dramatically. Okay, from about 800 people per million cases, 800 cases per million people, to now less than 80 per million people. So you can say that in the US, definitely it has helped to brought down the severity of this COVID-19. You can see similar trends in other countries like UK, Italy, which were also pretty bad at one time. Okay, but because they have gradually increased their vaccination rate, this has brought the number of cases down substantially. As for the bottom right side, you can see Malaysia. Malaysia is slowly, okay, but steadily increasing the vaccinated percentage. Okay, we started much later than a lot of other developed countries. You can see from the line there, most of them started at the end of last year, earlier this year, whereas Malaysia only started in end of February, early March. Okay, and the pickup rate was very slow at the start. Okay, but recently it has started to pick up. So for Malaysia, it may seem gloom and doom right now, but if you look at the evidence from other countries, you get the vaccination rate in the nation, bring it up, you'll start to bring the cases down. So for Malaysians, if let's say they want to get away from this, they may consider like taking business trip or holiday with family, go to places like France or Turkey, which have much higher vaccination rates and also much lower number of cases per million people. Okay. Anyway, so recently we have seen a rebound in consumer confidence, especially in these countries that have high vaccination rates. Okay, because what does this measure? If you look at consumer confidence indices, they actually measure the sentiment of consumers. Okay, whether they are willing to spend more money or save more money, buy bigger ticket items or small ticket items. So you can see that across the board that, okay, most of the especially developed economies, their consumers' confidence have already rebounded. Okay, it's an indication that one of the leading indicator that the economy is rebounding, because most of these economies, their GDP are consumer generated. The GDP growth, a lot of them are generated from consumer spending, consumerism. Okay, so people look at these numbers very closely. Okay, other than that, The consumer confidence also boosted retail sales. So when consumers have confidence of the economy, they'll go out and spend money. They'll buy bigger ticket items, especially like cars, fridge, and so on, the more expensive goods. And you can see this through the retail sales growth numbers as well. There's a big spikes in all these countries. Okay. When people spend more money, the consumers are confident. Businesses also become more confident, as you can see from the Purchasing Managers Index, another leading indicator. Okay, so the Purchasing Managers Index basically is a survey. They'll go and ask all the private sector companies whether you think that the outlook is good. Will you increase your orders? Would you buy more materials? Would you increase your inventory in expectation of better economy? So these are the surveys that are being done. And typically how we look at this is that a line of 50 is neutral. Okay, anything above 50 indicates growth, and anything below 50 is contraction. So you can see that after the contraction, the sharp contraction that we seen last year, most of these PMI numbers have substantially rebounded, okay, and they have stayed above 50 consistently since then, okay, which means that the economy momentum is quite strong, okay, going into this second half of the year, okay, and it's similar pattern for both the manufacturing PMI, okay, for manufacturers, and also services PMI, okay, which indicated both sides of the economy are doing well, and businesses are getting more confident. They're buying more materials, they're stocking out of inventory, and so on, in expectation of better business. Okay, so all in all, this improving macro backdrop is actually positive for risk assets. In fact, the IMF, they recently upgraded their growth forecast for global economy to 6%, okay, in 2021, and also 4.4% in 2022. And if you look at the charts right here, they expect a 5.1% growth this year for developed economies, which would basically reverse whatever GDP contraction that happened in 2020. And for emerging markets and developed economies, they are expecting a 6.7, a very strong number, 6.7% growth in 2021, and another 5% growth in 2022. Very strong numbers for growth in the emerging market and developed economies. And on the right-hand side chart, you can see they split it down into regions, okay, specific regions, US, Europe, Middle East, Central Asia. One particular thing to note is that the strongest growth will come from emerging market and developing Asia, which is expected to grow 8.6% in 2021 and 6% next year, the strongest growth among all the major regions. And this is after contracting just 1%, minus 1% in 2020. Okay, so which will paint the picture for our call for Asia and EM to be overweight going into second half of the year. All in all, if we look at earnings, okay, when the economy is doing well, people are spending more money, businesses are investing more in terms of capex, people are, you can see that these are all positive for corporate earnings. Companies tend to do better, okay, and we have seen that since the start of the year across all the major regions that analysts, they are becoming more and more positive on the corporate earnings for these companies. Okay, so you can see that the trend has always been the trend since the start of the year has been increasing. It's been upgrading. So typically earnings upgrades are positive tailwinds for equities. Okay, because companies earn more, it should be better for the stock prices, correct? Yeah, and going forward, we expect more earnings upgrades as the vaccine, the inoculation picks up. Okay, as more and more people get vaccinated, we expect more earnings upgrades. So, as a conclusion, we are emerging from the valley of virus. Okay, the U-shaped economic recovery is real, as you can see in US and Western Europe. Okay, they have rebounded very sharply. We expect Asia and EM to follow suit as the vaccination rate increases, okay, across Asia and EM. And this improving pandemic situation would boost sentiment. At the moment, it may seem doom and gloom in Malaysia. It was doom and gloom in US and Europe at one time. Okay, but then the cases started to come down. The economy has rebounded very strongly, and you can see it through the pictures that you may see in the videos that people are going out without masks. People are attending Euros, watching the final without masks, this kind of thing. So that's the thing that would continue to boost sentiment, okay, as the vaccination rate improves. Okay. Thirdly, the improving macro backdrop, as we can see, consumer confidence is up, retail sales is rebounded, PMI numbers are very strong. So all these are painting an improving macro backdrop, which are positive for risk assets. Okay, and these all in all put in together have seen analysts, okay, upgrading earnings for all these companies, which are positive tailwinds for equities as well. So all in all, as a conclusion, we think that going forward in second half 2021, we continue to favor risk assets, i.e., we recommend investors overweight equities over bonds. Next, we talk about Asia and EM, why we favor them over developed markets. So basically, the developed markets, they are the leaders. Okay, they have already came out of this pandemic doldrums. Okay, but Asia and EM are a bit lagging behind. So far, Asian equities have a bumpy year. They had a big rebound, okay, since the pandemic lows, okay, and also continued rally after Biden's U.S. election victory, which actually cleared a lot of uncertainties because of the trade war caused by the previous president. Okay, they had a good start of the year, as I mentioned just now. They had a good start before the end of first quarter when they had a retracement. Okay, due to certain reasons like the tightening of this Chinese tech regulation and also rising US Treasury yields. And so far, they have been held back because of a lot of COVID resurgences in several Asian economies. Okay, but we think that this retracement and also this sideways trading is actually an opportunity to re-enter. If we look at Asian economies, there are a lot of exporters. Okay, they export manufactured goods, your electronic products, commodities, commodity-related goods. They all come from Asia. So all these developed markets, when their economy is doing well, their consumers are spending, they're buying things. Where do they get their goods? Where do they get their their where do they get their products? They all get them from Asia. So you can see Asian exports have been booming. If you can see in the left-hand side chart, okay, we saw a big drawdown, okay, a lot of red color in terms of export growth. Red color means it degrowth, okay, it contracted because of the pandemic, okay, it slowed down a lot of supply chain, but gradually towards the end of the year, it has rebounded. Okay, and this year we have seen very strong export growth for a lot of Asian economies. Okay, similarly, the PMI numbers for Asian economies also paint the same picture. A lot of reds, okay, during the middle of last year, then slowly become green and then very, very green. Okay, so which indicates that a lot of managers, the purchasing managers, are getting more upbeat in terms of the outlook going forward. Okay, so we believe that the strong export growth in Asia will help to cushion all this uncertainty because of the COVID, okay, and keep the recovery buoyed. In terms of earnings, okay, if you look at the left-hand side chart, basically what we're trying to say is that in the past, there have been periods of earnings downgrade for Asian equities, okay, and there have been periods of earnings upgrades. And normally when there's earnings upgrades, okay, it will be quite a number of months. Okay, if you can see in the right-hand side chart, historically, when there's a period of earnings upgrade, it will continue. So just now I mentioned that Asian equities have been upgraded since the start of the year. It's only about 6 months in. Okay, there's still another, historically, it can go up to 12 months of continued earnings upgrades. And now we're only like about 6 to 7 months in to the earnings upgrade. There's still scope for more EPS revisions for Asian equities, which will be positive for Asian stocks. Or in other words, you can think of it like this. If earnings have been upgraded, but the prices have come down, that means it has been becoming even more undervalued, correct? Okay, because if you look at PE, earnings have been going up, but the prices have been stayed the same or have been going down. In other words, it is getting more and more undervalued. for Asian equities. So we foresee a strong earnings outlook for 2021 and 2022 for Asian equities. Another reason is that we think that the profit margins for Asian equities, the companies, are primed for a rebound. Okay, last year we saw a sharp decrease in profit margins, which affected their overall corporate earnings. Okay, but we think that this is now an inflection point. Profit margin will start to come back. Okay, and if you can see, we expect strong earnings growth for across all the sectors as well. It's not just one particular sector like tech or semiconductor, but across all sectors. So it's quite a positive sign going forward. In terms of valuations for Asia, as I mentioned, we think that it's cheap. Okay, so after the recent contraction, okay, and also the rally in developed markets, Asian equities are trading at a steep discount compared to developed markets now. So if you look at the right-hand side chart, okay, historically, Asian equities have traded around 12% cheaper compared to developed market peers. But because of the recent divergence, you saw a big rally in global equities, global developed market equities, and also Asian equities retraced or didn't rally much. Okay, this discount is now more than 21%. So I think this will be one of the key drivers for a recovery in Asian equities in the second half of the year, because the valuation gap has become wider. Okay, and especially if the positive vaccination rate increases, okay, it will bring positive sentiment to Asian equities. We should see Asian equities start to rebound and catch up to developed market equities in terms of valuations. All in all, we are optimistic in Asia. We rate it 4 stars, very attractive, because we think that near-term, medium-term, and long-term equity drivers are still intact. Okay, we're still positive, and valuations are very cheap. If you look at the PE ratio, they're trading at 12.6 times forward 2023 PE. Okay, and compared to our fair PE of 16 times, this is representing an upside of more than 27% for Asian equities. Now I move on to emerging market equities. So similarly to Asia equities or Asia, EM is a major exporter also of commodities and also product, especially commodities. And EM similarly had a strong run after the COVID retracement last year. Okay, before the end of first quarter retracement, and currently is trading around sideways. But we think that the sell-off is not fundamentally linked. Okay, the EM's recovery is still pretty much on track, because both the macro and corporate side are still healthy in our view. if we look at the left-hand side chart here, this is a chart which plots the earnings sentiment for emerging markets compared to the forward earnings 12 months for emerging markets. So what I'm trying to show here is that typically, if you look at the lines, the earnings sentiment will move ahead of the EPS. It's like a forward indicator for EPS. Okay, so when the sentiment increases, okay, it will be followed by EPS increases as well. Okay, there's a correlation over there. So what we've seen recently is that there's net upgrades for earnings sentiment for emerging markets, which should come with upgrades in forward earnings as well. Secondly, in the right-hand side chart for emerging markets, in terms of growth, it's still one of the strongest growth regions, okay, compared to US, Europe, Japan, China, these other developed markets, or even China. EM, they are expected to see very strong earnings growth, okay, 37.5% in 2020. 2021, 19.4%, 12.1% in 2022. Okay, so very strong earnings growth for EM expected going forward. In terms of valuations, EM is, after the retracement, has become even cheaper. Okay, historically it was cheap. Okay, but the last year's strong rally, it has gone above the historical average, but relative to developed markets or other regions, they're still relatively much cheaper, much more compelling. If you look at the right-hand side chart, it's a similar chart comparing the valuations for EM compared to developed markets. Okay, and historically they have traded at around 22% discount compared to developed markets. Okay, but because of this divergence in performance, now they're trading at 30% discount compared to developed markets, which is another compelling reason why we are favorable for emerging markets. All in all, we rate emerging markets 4 stars, very attractive. Okay, and we think that the dips may be short-lived because the underlying factors for emerging markets are still there, like strong earnings growth, and they are typically more cyclical oriented. Okay, which is cyclical oriented means that if let's say markets do well, they typically do well as well. Yeah, so the catalyst for EM is still over there. And in terms of valuations, they're still very cheap, trading at around 11 times forward 2023 earnings. Okay, compared to our fair PE of 13.5 times, which puts it the upside potential at more than 20%. Thirdly, I'll talk about China. Okay, it continues to be one of our favorite markets, and we think that the pullback in Chinese equities is still a buying opportunity. So after the New Year, the Lunar New Year, we actually saw a retracement for Chinese equities, which was triggered by the uncertainty caused by the increased tech regulation by the Chinese government. Okay, but in terms of the macro factors for China, it's still looking very strong. Okay, the growth outlook remains very bright. If we look at economic activity on the left-hand side there, which there's this economic indicator such as industrial production, retail sales, fixed asset investment. This has already rebounded, okay, which signifies a recovery of activities within China. Whereas PMI numbers in China also in expansion territory, which shows a sign of improvement in the Chinese economy. Okay, so similarly, PMI numbers above 50 suggest expansion for both manufacturing and also services. They show the same trend. This will be good for corporate earnings within Chinese companies. Okay, and you can see that they have the left-hand side chart is a chart plotting the leading indicator index compared to EPS growth for China corporates. Okay, so the leading indicator index will take into account the few indices or the few statistics that I showed you just now, and typically they are also a sort of leading indicator for how EPS growth would perform. Okay, if you can see, if the leading indicator ticks up, okay, typically it's a good sign for EPS growth for China. Okay, there's a correlation there as well. And if you look at the right-hand side chart, it basically shows that valuations have already come down after the recent market retracement to a healthy level, in fact. Okay, so in 2020, a lot of the growth, or you say the gains for Chinese equities were because of the valuations going up. Okay, not really supported by earnings growth, but going forward with earnings growth being so strong, it will be the driver for Chinese equities more than compared to the valuation, the increase in the valuations. In China, we still maintain a 4 stars very attractive rating for Chinese equities with an upside of more than 25%. So in terms of PE, they're trading around 11.6 times forward PE, which is a few multiples cheaper than the fair PE of 14.5 times. Okay, and earnings growth are pretty strong going forward, expected also with more than 25% earnings growth in 2021, 2022, a 19% earnings growth, and also 10% growth for 2023. So I mentioned that rather than looking at multiple expansion, okay, as a driver for Chinese equities gains, we'll be looking more on earnings growth as a driver for the gains for Chinese equities going forward. In the next one, I'll be talking about the fifth point, okay, why we think that investors should invest in medium to long duration Malaysian bonds, switch into this compared to a short to medium duration at the start of the year. So firstly, pretty sure you're all aware that we have been the government has put us on the lockdown, okay, which actually dented the domestic economy because a lot of businesses they weren't allowed to run, okay, except for certain essential industries. So activity has come to a halt. You can see through the recent statistics like the PMI numbers, which dropped to 39.9 in June, way below 50, okay, which is no surprise because businesses turn cautious because of the lockdowns. And subsequently, as these recent developments come in, the GDP growth forecast for Malaysia has also been downgraded. Okay, so you can see that in February they were expecting 5.5% growth for 2021, 5.7% growth for May, in May for 2021. But because of the recent lockdowns, it has actually caused a slashing of the GDP growth forecast for Malaysia. So overall, with the economy slowing down, Bank Negara is most likely going to maintain OPR for the foreseeable future. And they'll also look through the inflation spikes that we saw in March, April, and May, because most of these will be coming from the low base effect after the retracement, after the contraction that we saw last year. Okay, because if you remember, oil prices were very low, they dropped significantly. Okay, and because of cost push inflation as well, because a lot of these commodity prices have gone up, okay, which caused maybe prices to go up in terms of goods and a lot of goods or products, but it's not because of a demand pull inflation, which is caused by an overheating economy. So Bank Negara will most likely look through these inflation rates as more transitory, and they'll continue to keep rates at this level for the foreseeable future. We expect until at least third quarter of 2022. So this the next point will be why we think that now is a good time to enter into medium to long duration bonds, other than Bank Negara keeping interest rates low for at least until third quarter 2022. Okay, yields have already picked up. Okay, so the yields for bonds with the benchmark Malaysian government yields have already gone back to pre-pandemic levels. If you can see in the left-hand side chart here, the blue line is the benchmark Malaysia 10-year yield, and it has gone back to pre-pandemic levels before all these rate cuts happened. So essentially, markets are already sort of priced in all the rate cuts back to the pre-pandemic level. So we think that the downside for Malaysia bonds is limited, okay, because we think that the yields don't have much more higher room to go up, okay, which is why we think that medium to long duration bond is a good entry point right now. Other than that, we also see opportunity within lower rated and unrated credit. If you can see in the right hand side chart here, okay, this plots the spread between the different credit rating bonds compared to the MGS, the benchmark yield. And for AAA, AA rated segments, they are quite tight. You can see these lines over here, they're quite tight. Okay, means their yields are very similar or just slightly above the MGS yields. So they don't give much room for buffer for investors. But if you look beyond this, look into the single A rated papers, the spread is much bigger. Okay, and the yield pickup is so attractive. So if, for example, let's say you were to invest in a AAA rated bond, the spread between the AAA rated bond and the MGS 10-year is only like 50 basis points. That means if the MGS is giving a yield of 3.2%, the AAA bond is only giving 3.7% yield. Okay, whereas if you invested in the low rated bonds like single A 1 rated, the spread is 200 basis points, or this one A3 rated is like 450 basis point spread. That means add it on to your MGS of 3.2%, you're getting like a 7%, you're getting like 7.7% kind of yield. Yeah, so the yield pickup is much more attractive, which we think is an opportunity. Okay, so all in all, for Malaysian bonds, medium to long duration is good because we think that the downside risk is lower. Okay, there's little room for yields to go up more. We think that that yields will probably stay around this level. Okay, which means bond prices will be quite steady. Okay, then on the other hand, lower unrated bonds give substantial yield pickup compared to higher grade bonds. And we think that this spread will also help to cushion a lot of the interest rate volatility. Okay, because when you start to pick up, okay, all these yields will also start to move, which will affect the bond prices. But if you have a good spread, good cushion between, okay, it will actually help to lower the volatility. You won't drop as much compared to the higher rated bonds. Okay. So lastly, okay, to wrap things up, in terms of key investment themes, we think that the themes are still mainly intact. Okay, we still favor risk assets. We still favor Asian EM over developed markets. Our favorite markets: China, Korea, Taiwan, Indonesia, and Brazil. Digital economy and healthcare are still mega trends that we foresee will do well. And for Malaysian bonds, we recommend taking a medium to long duration position in, and also taking a bit more credit risk, go into lower unrated credit. And we see value in Asian high yield and emerging market bonds for those who want to diversify their bond portfolio. Can look into Asia and high yield and EM bonds. Next session we'll be talking about how we select our recommended funds. Just to give you a quick recap, how did our recommended funds last year do? Okay, in the mid of last year, we also released our recommended funds, which included 36 recommended funds, and all in all, 34 out of the 36 produced positive returns, which with a 94.4% win rate and an average return of 18.6%. And 67% of the funds on the list returned more than 10%. All 18 equity funds were positive, returning an average of 29.3%, and all 7 balanced funds returned positively with an average of 15.6%. The laggards were bond funds because of the retracements that we saw at the end of first quarter, okay, caused by the spike in the US Treasury yields. Overall, 8 out of 10 bond funds were positive, only 2 were negative, but the average return was a bit is only 1.7%, which could be quite disappointing. But if let's say you have a diversified portfolio across different asset classes, you will still do pretty well. Okay, because for example, let's say there were 36 funds, you just buy all the 36 funds, your average return will still be pretty decent. Next is how we select our recommended funds. So our recommended funds methodology is different from others who mainly look at performance only and across one time period only. Okay, so for us, we look across different factors. Out of the 500 plus funds that we have on our platform, okay, we perform quantitative analysis first. Firstly, we segregate the funds by category. For example, we put all the core equity Asia and Japan funds together. Then we assign scoring for each fund relative to their peers in the same category. Okay, based on their performance in terms of calendar year returns, cumulative returns, rolling returns, and across different periods, not only just 1 year, but we look 1 year, 2 years, 3 years, 4 years, 5 years, and so on. Okay, across different periods, so that we can gauge their consistency. We also assign scoring based on their risk, looking at downside volatility and also maximum drawdowns over different periods as well. And lastly, we also score them based on their expense ratio, because we think that expense ratio, if it's too expensive, it may eat into the profits of the gains for the customers or the investors. Then thirdly, we'll calculate an overall score. Okay, we have scores for their individual quantitative categories. Then we will assign a overall score, okay, using assigned weights. So for equity funds and balance funds, we'll place more emphasis on the performance, whereas for bond funds, we'll place more emphasis on the risk and also the expense ratio, because for investors who invest in bond funds, they typically want to invest in something more stable. And because bond funds, they're typically, you can say, their returns are lower, so the expense ratio could actually eat into a lot of the gains for bond funds. Therefore, we put more emphasis on the risk and expense ratio for bond funds. And finally, once we do the overall score, we add an additional screening, okay, qualitative side, before we come out with the recommended funds. So we look at other qualitative measures such as fund size. For example, like once again, bond funds, if the bond fund size is too small, okay, they may not be able to diversify into a lot of different bond papers, because for example in Malaysia market, a whole lot bond paper, okay, corporate bond interbank is trading at 5 million lots, okay, for MGS is trading at 10 million lots. So if the fund size of the bond fund is too small, let's say 10 million, they can only buy 2 bond papers, or they will need to buy odd lots. So the risk of doing odd lots is that you may not get the best price, okay, and when you sell, there could be liquidity risk, because not everyone would be willing to take up the odd lots. Okay, in terms of portfolio positioning, we also look at that. If let's say the portfolio is too over concentrated in one bond issuer, for example, or one stock, then the risk could be too high. We may take the fund out. So ultimately, after we go through all this process, we'll come out with the top ranked funds, and these will be the recommended funds for the individual categories. So if you want to know more, you can visit the website. Okay, there's a link which lists down all the recommended funds, and also there's a specific page on the website. If you go to the website and the top bar, you go to funds, under research and recommended funds, you click this, then there's one whole page will list down all the recommended funds and also the write-ups to explain the fund. Okay, if you want to know more. Okay, that's all from me. I think I've overrun the time.
Yeah, thank you very much, Mr. Jason. It's definitely food for thought. So now we will be having a 3 minutes break, and there will be more and more insightful topics to be covered later. So to stay tuned with us.
Yeah, so if you have any
So welcome back everyone. Now we will now hear from Mr. Jerry Lee Chiyong. He will be deep diving into building an all-weather portfolios to handle all sorts of market volatility. Mr. Jerry Lee is currently a portfolio manager of FSMOne Malaysia. Besides managing the IFAS and FSMOne managed portfolio, he's also managing the private mandates portfolios for high net worth clients. Prior to this, he was a treasury dealer at Affin Hwang Asset Management, dealing in foreign exchange trades as well as money markets instruments. He graduated from Tunku Abdul Rahman University College with first class honors, and Jerry is also a CFA charter holder. So, ladies and gentlemen, please welcome Mr. Jerry Lee. Mr. Jerry, the hall is yours.
First of all, just a quick introduction about myself. My name is for some of the regular investors who have met me before. My name is Jerry, and for some of you, first time meeting me, my name is still Jerry. I'm the portfolio manager for FSMOne, and I will be your speaker for the next 45 minutes. Today, I will be sharing on the title of how to construct an all-weather portfolio by leveraging on the FSMOne recommended fund methodology. So moving on to the next slide, before I start, just a quick disclaimer here. So basically, it's similar to what Jason has shared earlier. The message here is that whatever information that I'm going to share with you later on, for some of the investors, if you want to make any investment decision, please do your own homework, study the fact sheet, study the product highlight sheet, understand the risk of the underlying products. Yeah, so allow me to move on to the next slide here. So basically, you can see over here, these are the contents of my sharing today. I will first start with some of the common investment mistakes that investors tend to make during their investment decision process. And if you're able to avoid this mistake, I think you could potentially avoid huge losses in your investment journey. And the second part of my presentation will be on the FSMOne portfolio methodology. I will be sharing with you on the similarity between some part of our investment, our portfolio methodology with the recommended fund methodology that Jason have just shared earlier. And last but not least, I would also like to take this opportunity to share with every investor here on the portfolio performance for our portfolio, and also what is the current portfolio strategy given the current situation in the global markets. So without further ado, allow me to move on to the next slide here to start my presentation with the common investment mistake that we think most of the investors will make. So a very first question is to ask yourself, have you ever come to a point where you do not know what to buy or what to invest for your own portfolio? So to answer these questions, try to think about it. Do any one of you ever come to this place, which is the FSMOne platform, to look for the best performing funds to invest for your portfolio? So probably it can be, the best performing funds in the past 3 months. It can be the best performing funds over the past 6 months. But basically, investor will go to the list of the best performing funds to choose what to buy. And don't get me wrong here, past performance is definitely one of the factors that we should actually consider when we evaluate a fund. But we think that investors shouldn't just look at the past performance to make their investment decision. So for example, if you look at the funds that perform 100% in a year, for example, last year, we have quite a number of funds that delivered more than 100%, for example, those technology funds. And investors shouldn't have that kind of same expectation that, these funds that delivered more than 100% in the year of 2020, it will continue to deliver such performance moving forward. So I would like to reiterate here, no doubt that performance is one of the key factors to evaluate the funds over a long period of time, but do not solely looking at performance to make your investment decision, because there are a lot more factors that investors should consider. And then later on in my session, I will actually share with you some of the factors that you should consider when you construct your portfolio or when you build a portfolio for your own self. And if we move on to the next slide, over here you can see that this is another another mistake that most of the investor will make. Because of the earlier mistake where investors tend to invest usually looking at the best performing fund to decide which to buy for their portfolio. And sometimes they might end up having a concentrated exposure within a similar sector or specific country. For example, let me give you a very good example. Last year, if you look at the best performing funds in the year of 2020, very likely you will see most of the technology names, you will see most of the China equity names. So if investors just look at the best performing funds list to look at which funds to consider which fund should I buy for my portfolio, probably early this year, a lot of the investors will end up having high exposure in technology, having high exposure in China. And because of this, it leads to the second mistake, which is putting all your eggs in a similar baskets. So when it comes to this common mistake, we actually talk about diversification. And when speaking of diversification, I think the first perception that a lot of the investor will have is that if I diversify my portfolio, to a certain extent, I will have to sacrifice the potential returns that I could get from the markets. And this is not exactly true. Let me explain to you. If you try to take a look at the table here, you can clearly see that the best performing market in every year is always different. And so if you put all your eggs in one basket, let's say, if you just invest into China equity market since the year of 2008, probably you will have missed out the decent return that you could obtain in different market in every particular year. So what I can conclude here is that diversification is something very, very important. And I think what is more important here is also to have a proper and systematic approach to build and also construct your portfolio. Later on, I will share with you a few tips how our investor can actually construct their portfolio based on the few steps that I'm going to mention later on. And if I move on to the next mistake here, okay, we also found out that most of our investors, they actually like to time the market, moving out from one market to another market within a short period of time. Because I think as a human, you always think that we can do better. We can actually beat the market and we will be able to buy at the lowest and sell at the highest. I'm not too sure if you're able to do it consistently, right, or you can able to do it consistently, time the market accurately consistently. But what I have to say is that I got to very honest to every one of you that for me, market timing is really something very, very difficult. And what you can see here is that if you time the market wrongly, you have to pay a very, very huge cost for it. So try to take a look on this chart here. Let's say if you look at on the most left-hand side, if you stay invested in the markets on your most left-hand side, you probably have enjoyed about 268% from the global equity markets and probably close to 400% from Asian equity over the past 20 years. But let's assume if you try to time the markets and you miss out just 10 days of best returns over the past 20 years, your total returns will be cut by half to only about 100% for the global equity market and also about 170% for Asian equity market, as compared to if you stay invested in the markets, you will probably obtain about 400% from Asian equity market. And worse to worse, if you miss out just 40 days of best return over the past 20 years, you will suffer huge losses for your portfolio. Hence, I think what we can conclude here is that not only that market timing is extremely difficult, but if you fail to time the market correctly, consistently over the time, you will have to pay a very huge cost. You will have to sacrifice a potential return that you could obtain if you stay invested in the markets. And allow me to move on to the next slide. I think of another example here is that I believe some of the experienced investors here, you will probably know this famous fund manager. His name is Peter Lynch. I think he managed this fund called Fidelity Magellan Fund between the period of 1977 to 1990. So if you look at it within this 13 years period, his funds delivered an annualized return of 29%. It's such a decent return over a 13 years period. 29% every year over a year of 13 over a period of 13 years. But what they found out is that on average, most of the investors that invested into their fund, they actually lose money over this 13 years period. And Fidelity actually found out that the main reason is because investors tend to sell the fund or sell to redeem their capital from the fund during a period of a low performance. And they buy back the funds after the funds has delivered a strong returns. So what we can conclude here is also that investors tend to chase after the funds have delivered a good return. Investors tend to chase after return, and when market is very quiet and and the funds deliver a low performance, investors tend to redeem. So the lesson here, what we can learn is that we should not just look at performance as the only factor to consider whether or not we should buy the fund. So I think with that, I pretty much conclude the first session, which is the 3 common investment mistake for the investor that you should bear in mind to avoid such a mistake. So we'll just recap. The first mistake is that don't just look at performance to select a fund. There's a lot more factors that investors should consider when you pick a fund into your portfolio. And the second here is that do not put all your eggs in the same basket. You need to diversify your portfolio. Diversification, not only that it helps to reduce the downside, it reduces the volatility of the portfolio. At the same time, it allows you to capture the growth opportunity in the global markets. Last but not least, the third mistake that most of the investors make is that they always time the market. So please do not time the market and stay invested in the market. Why so? Because markets will eventually reward investors with great patience. And allow me to move on to the second part of my sharing today. Is regarding the FSMOne Managed Portfolio. So if you look at it, the FSMOne Managed Portfolio is an all-in-one portfolio management service that we provide to all our investors. Because over the years, when we first started in Malaysia, we first started as a unit trust distribution platform. And slowly, we have more and more funds in our platform. And we found out that at this point in time, we have more than 500 unit trust funds. So sometimes it might be rather difficult for investors who are not from the investment industry to understand all the funds, to understand the market, and to do their own research. So for those investors who who prefer a more hands-off approach to manage their wealth, they can actually consider the FSMOne Managed Portfolio. So just as a brief introduction about this portfolio, the portfolio is actually constructed and actively managed with a systematic approach, which I'm going to share with you later on about how we actually construct and also manage the portfolio. At the same time, I think investors can also enjoy portfolio rebalancing, auto portfolio rebalancing with no cost. There will be no additional charges to investors when we rebalance the portfolio, when we switch out some of the underperforming funds in a portfolio and replace it with another good fund. There will be no cost to investor at all. I will also want to highlight another thing, that this portfolio, although it is managed by the local portfolio management team, but we're actually leveraging on our regional expertise with more than 30 analysts and also portfolio managers regionally. Because in IFAS, in fact, FSMOne, we actually operate in 5 different markets. Not only in Malaysia, but we're also operating in India, in Hong Kong, in Singapore, and also in China. And on a weekly basis, all the analysts and also the portfolio managers, they will actually exchange their markets view on a weekly basis. Yeah, and I move on to the next few slides, which I'm going to explain further to you regarding the portfolio construction methodology and also how we actually manage our clients' portfolio. Yep. So if I move on to this slide here, what you can see here is that these are basically the steps how we actually construct the portfolio for our clients. And for investors who prefer to build their own portfolio, I think these are also some of the questions that you should actually ask yourself. Not just jump into which are the best performing funds and decide which to buy for your portfolio, but you should actually go through this proper step to construct your own portfolio. So the first step here is actually regarding the inter-asset allocations. So if you look at inter-asset allocation, it means that how much do you allocate your capital between bonds versus equity. So there are a few factors that investors should look at it. The first factor is that you need to know your own risk profile at the first place, because if you are a balanced investor, probably you will have sort of a balanced allocation between bond and equity 50-50. But if you are more aggressive, probably your portfolio will be having more into equity and less allocation into the fixed income. Secondly, besides looking at your risk profile, you should also evaluate the global economic conditions, the valuation between bond versus equity. Because when economic condition is fantastic, we see a promising outlook for the global economy, equity will tend to outperform bond. And that is the time that you need to actually overweight equity and underweight bond. And when valuation for equity is much attractive as compared to bond, there's also a time where you need to actually put more of your capital into the equity portion. So the first step that you need to know is actually to understand your risk. to understand the global economic outlook, and also to know the valuation between equity market and also the bond market for the global equity and also global bond markets. And if we move on to the second step here, which is the intra-asset allocation. So let's assume that now you have already decided that you need to put 50% of your capital in equity and 50% of your capital in fixed income. The next question you got to ask yourself is that, so for example, if I know that I got 100,000 to invest, 50,000 will be put into equity market. So within this 50,000 for the equity market, where should I invest? Now, which market should I buy? At this point in time, should I buy US equity market, or should I buy European equity market or China equity markets? So for our portfolio, for the FSMOne managed portfolio, how we actually construct our equity market is that we follow the MSCI GDP weighted index to allocate the capital for our clients, because MSCI GDP weighted index, it reflects the current state of the economy, and it's actually consider the potential of the global economic growth before they allocate the weightage to each of these country. So we actually actively manage the allocation, and on an ongoing basis, right, we actually actively manage our allocation for all our investors. So this is actually how we actually address the second step here, the intra-asset allocation. We look at different indices. We look at MSCI GDP weighted index to allocate the capital for the equity portfolio of our clients. And if we move on to the last step here, which is a step that I'm going to further explain a little bit more today for the sharing on the fund selection step. So if you're aware, right, just now I've shared with you the few steps that how we actually construct the portfolio. We do have a systematic approach to see that, how much should we allocate between equity versus fixed income. Then subsequently, within equity, where should we invest? Within fixed income, where should we invest? Which is the intra-asset allocation. Then only followed by the third step, which is a fund selection. Which are the funds should we invest for our client? But most of the time, when investors construct their own portfolio, they straight away jump to the third step and see which are the funds they should buy without looking into the first and also second step. And this is exactly the reason why investors sometimes they will end up with a high exposure within one segment, because they never really study this fund, whether or not they are actually buying into technology stock, whether or not they are actually buying into the China equity stock. So let's go into a bit details about the fund selection step. The next step here, I think basically just now, Jason has also briefly shared about some of these factors. We break it into two sets of data that we're going to analyze for the fund selection step. The first step is actually on the quantitative data. Sorry. Okay, the first step is actually on the quantitative data. So on the quantitative data set, we're actually looking at a few things like performance, the expense ratio, and also the resiliency. So I think just now, Jason had briefly touched on it. I'm not going to go into very details on this. And I think these three factors are no stranger to every investor, most of the investor here. Just to highlight a little bit on the performance side. For the performance, we don't just look at cumulative returns. At the same time, we also look at the calendar year's return. The reason why we look at two sets of returns is because, try to imagine and give you an example here. If let's say I have two funds, funds A and also funds B. Both the funds have 5 years of cumulative returns of 100%. I think investors will have no idea, have no clues which fund should I buy, because both the funds over the past 5 years, they also delivered 100% over the past 5 years period. But how if I tell you Fund A delivered 100% in the first year and subsequently no returns, but Fund B delivered 20%, close to 20% every year for the past 5 years periods? So it's very obvious that we will go for Fund B instead of Fund A. The reason why is because Fund B is more consistent when it comes to performance. But Fund A, they only deliver 100% in a particular year. We do not sure whether or not in that particular year, the performance is driven by whether or luck, or whether it's the outstanding stock picking skill of the fund manager. So these are some of the things that we need to evaluate. When we're looking at performance, we cannot just look at the cumulative performance, because we need to ensure that the consistency of the performance is there. So at the same time, we need to look both cumulative and also the calendar year's performance. And if we move on to the next slide here, actually for us, what is actually more important, or the factors that can contribute more alphas to our portfolio is actually the qualitative factors. And if you think about it, right, quantitative factors, if you look at just now, I show you the three quantitative factors: performance, expense ratio, your resiliency. These quantitative factors, basically, they are actually the historical data. They're actually still important, but what's more important is the qualitative factors, which can tells you like how likely that the funds is going to perform in the future, because quantitative is a historical data, but qualitative is the factors that going to let you to evaluate whether or not the funds will continue its strong performance in the past. So what are the qualitative factors that we will consider? I think just now Jason had mentioned quite a bit. Maybe I highlight the other few things, that for example, if you look at some of the qualitative factors that we like to evaluate is that, for example, the management team or the investment team of the funds. Let me give you a regular example. If you let's imagine today, if you invest into fund, for example, fund A, and this fund A is managed by a star fund manager. The fund manager make all the investment decision. He make all the stock picking decision. So based on the historical performance over the past 3 years, 5 years, with the fund managers managing the funds, you realize that the fund is extremely good. You know, it outperformed all the peers, outperform all the indices, all the benchmark over the past 3 and 5 years. So because of that, you decided, let's buy the funds. But how if 3 months later, the fund manager has left the fund house and moved to the other fund house? If you still continue invested and stay invested with the funds, the past performance that you have evaluated earlier on, it suddenly become meaningless, because all this performance in the past is actually contributed by the star fund manager, but now the star fund manager has left the fund house. So these are the things that we need to track and we need to know from time to time. For all the funds that we have invested in our portfolio, we will actually speak to the fund house and speak to the fund managers regularly to actually understand their strategy, understand the current situations of the fund. And there are also some other factors which later on, when I review some of the portfolio changes that we made in the year of 2020, I will actually share with you another example later on. Yeah, so basically these are some of the factors that investors should consider. So try to bear in mind, when it comes to evaluating whether or not I should invest into a fund, don't just look at the quantitative factors. Quantitative factors will tell you how the funds perform in the past, but qualitative factors will tells you that how's the funds is going to perform in the upcoming future. So it's very important for us to also evaluate some of these qualitative factors. Yeah, if we move on to the next slide here, so we can see here's basically the performance of our portfolio. If you look at the table at the top here, this is the performance of our conventional portfolio, and the table at the bottom here, that is the performance of our Islamic portfolio. So we can see for our conventional portfolio on a year-to-date basis, our portfolio actually delivers returns ranging from 0.9% to about 7.6% for the first half of 2021. And in the year of 2020, our portfolio also delivered quite a decent returns. Aggressive portfolio delivered about 18.1% returns, and conservative portfolio delivered about 7% return. So if we also look at the Islamic portfolio, year to date, our Islamic portfolio delivered a returns ranging from 0.8% to 6.2%. And on a same in-session basis, the conservative portfolio delivered 16.2% returns, I think over a 2 years period. We started our Islamic portfolio in the year of 2019, so it's about 2 years period, about 16.2% for conservative and about 35.1% for the aggressive portfolio. So in the year of 2020, our aggressive portfolio for Islamic portfolio also delivered about 18.7%, where conservative portfolio also managed to clock about 8.4%. So this is the performance of the portfolios over the past few years. But there are also some other things that I would like to highlight over here. When it comes to managing a portfolio, we always think that it's not just about, although we know that performance and return is something very important, but what's also important to us is how we actually manage the drawdown, how we actually manage the volatility of the portfolio. So if we move on to the next slide here, you can actually see the portfolio drawdown versus the global equity market. So like for example, during the recent drawdown from mid-February to end March 2021, we can see that markets like China equity markets, Asian technology, or even Nasdaq, they have actually dropped by on the double-digit magnitude. But our portfolio, the most aggressive portfolio, which 90%, which have a 90% of allocation in the equity space, only suffer a maximum drawdown of 7%. Meaning to say that from February to March, this period, it fall from the peak to the bottom, it only dropped about 7%. But if you look at the global equity markets, some of the China equity, Asian tech, they actually dropped more than 15-20% over that 1.5 months, 2 months period. And next slide here, what you can also see is that, move on to this slide, you can also see that how's our portfolio perform during the 2020 global equity market sell-off. So you can see on the chart on your left-hand side here, during the sell-off, our aggressive portfolio actually dropped much lesser compared to the global equity markets. Our aggressive portfolio is actually the one that in the blue color line, and the one in the red color line is the global equity market. So I mentioned earlier on, generally people will think that if I diversify my portfolio, if I put into few different asset class, if I put into few different regions, if I diversify my portfolio, I will actually have to sacrifice the potential return that I could obtain for the global equity market. But that's not the case for our portfolio, because if you look at the chart on your right hand side here, you can see that our portfolio also managed to outperform the global equity markets during the subsequent rebound from mid-March to end of December 2020. So because of our active management strategy and also the systematic approach that we've implemented to manage the portfolio, we actually managed to outperform the global equity market both during the sell-off. We tend to be more resilient, but during the subsequent rebound, we also tend to perform much better as compared to the global equity markets. And over here, these are basically the changes that we have made to our portfolio in the year of 2020. I'm not going to go through every one of the changes here due to the times constraint, but just to highlight item number 5. If you look at item number 5 here, we on the 1st April 2020, we have replaced, for the Islamic portfolio, we have replaced BIMB Arabesque Global Dividend Funds with the Principal Direct Equity Fund. So subsequently, this the new fund that we've included into the portfolio, which is Direct Equity, actually outperformed BIMB Arabesque Global Dividend by more than 12%. So just to explain a little bit the underlying reason why we actually conducted these changes for the portfolio. The reason why is because back in March 2020, after the global equity sell-off, we actually realized that this fund, the global equity fund for BIMB, they hold substantial cash in their portfolio. I think if you're aware of this fund, they actually managed by momentum strategy. So when the market is very weak, they will try to sell the equity portion and move it into cash. And because of this strategy, the fund holds substantial cash after a global equity sell-off. But back then, we do think that the global equity market is likely to outperform, it's likely to rebound very strongly due to the plenty of liquidity being injected by the global central bank and also the global governments. So we do have the expectation market is going to rebound. But if we continue hold on to this BIMB Arabesque Global Dividend Fund with 60 to 70% in cash, we wouldn't be able to enjoy that kind of a rally in the global equity markets. And that's exactly the reason why we replaced the fund with Principal Direct Equity. If all the way back to March last year, if you compare the performance of BIMB Arabesque Global Dividend with Principal Direct Equity, you will realize that BIMB Arabesque tend to be a better fund as compared to Principal Direct Equity from the performance perspective, from the past performance perspective. So again, we would like to highlight that when evaluate a fund, when we decide what to invest into the portfolio, not just solely looking at performance. Performance factors is important, but it's not the sole factor. It's not the only factors that investors should consider when they make any investment decision. Yeah, and allow me to move on to the next slide here. So basically, these are the changes that we have made to our portfolio in the year of 2021. Early this year in January, we have actually reduced our China equity exposure. We have also cut our global technology exposure after including technology funds back in April 2020 and enjoying about 70 to 80% returns from this global technology fund. We think that the valuation to a certain extent has went a bit too stretched. And I think as a house, we also think that the valuation for technology is a bit too expensive. So that's why we actually cut our global tech and also China equity exposure back in early this year, and we actually increased our exposure to European equity and also emerging market equity. So these are the two regions that we have increased our allocation. And in the month of February, we have also replaced the global equity fund that we have included into the portfolio earlier on. We replaced the principal direct equity with RHB Islamic Global Development Market Funds. So, during the same month, we also added RHBI Global Sustainable Restructure Fund, a global technology fund, into our Islamic portfolio. And in the month of May, we have turned our overweight position to neutral for our Japanese equity. With the slow vaccination rate, that's one thing. And second thing, we also think that there is a lack of good Japanese equity fund within the platform. So we have decided, since we have more opportunity elsewhere, we actually wanted to underweight to reduce our overweight position, to reduce our exposure to Japanese equity. We have added that exposure to the Asian technology space. So the Asian Technology Fund that we've included into our portfolio back in May is the RHB Pacific Technology Fund. So we are aware that Asian technology has suffered a significant drawdown since February this year. I mean, mid of February this year, because of the increased regulatory issue in China that affected the overall Asian tech space, especially the China technology. The big names like Alibaba, your Meituan, or even recently Didi, they also went under the investigation by the Chinese government. So this has caused a broad market weakness for China technology and also Asian technology, and we see an opportunity within that space. That's why back in May we actually increased back our technology exposure, and we allocated into the Asian technology space with slightly higher allocation into the China technology segment. So in July recently, we have also replaced our China equity fund and also Malaysia equity fund. So we will further explain this in our upcoming fact sheet next month. So stay tuned for the fact sheet to know more about the changes on our recent changes for the China and also Malaysia equity fund. So over here, just a quick update on our current strategy for the FSMOne managed portfolio. At this point in time, we actually still overweighting equity by 2.5%, and we actually underweight fixed income. We see there's still opportunity within the equity markets as compared to the bond markets. And within the bond market, if you look at the table on your right-hand side here, you can see that similar to what Jason has shared earlier, we're actually underweighting the Malaysia short duration bond. At this point in time, we still see great opportunity within the Asian high yield. The high yield fund that we are investing right now, I think they're actually providing about 8 to 8.7% of yield to maturity. So it's still a very decent yield to maturity from an Asian high yield perspective. So we have allocated 10% into the Asian high yield space. Within our equity segment, at this point in time, given the stretch valuation, we're actually underweighting US. We slightly increased our European equity allocation early this year, but we're still having a slight underweight position in European equity. I mentioned earlier on, we turned our Japanese equity exposure from overweight to neutral at this point in time. The market that we like is definitely China equity markets, Asia, Japan, and also emerging market equity. At this point in time, we are having quite a significant underweight exposure in Malaysia equity. I think we are actually underweighting Malaysia by 5.5%. And similarly, I think we have our tactical exposure for our healthcare segment. So we have a tactical exposure of 5% to the healthcare segment. So these are basically the strategy for our portfolio at this point in time. We are still slightly bullish on equity markets, and the market that we like are actually Asia, Japan, and also China equity markets. And move on to the side here. I think for some of the regular investors that attended a few of our events before, probably you were aware that we like to show this chart to every investor when we explain how we are going to manage our portfolio. Because sometimes those things, those methodology that I explained just now, it will sound a little bit too technical to some of the layman investor. So in order to make it more simple and make it more layman, for us, managing a portfolio is really similar to managing a soccer team. Why do we say so? Because when it comes to managing a soccer team, try to imagine yourself as the soccer team manager. The first thing is that you will have a formation that covers the entire field. Similarly, when you manage your portfolio, you need to have your fixed income exposure, you need to have your equity exposure. So to have a formation, for example, if you are playing 4-4-2, 4 defender, 4 midfielder, and 2 striker. So who will be your defender? The fixed income fund will be your defender. So you have your Malaysia bond, you have your global bond, you have your Asian bond as the defender for the portfolio. And then move one layer up for your midfielder. So for your midfielder, they are basically your core equity fund, the regional equity fund, your global equity, your Asia and Japan equity, your emerging market equity. And the striker, basically, they are the high risk, slightly high risk and high concentrated fund. For example, single country equity fund, your China equity, your India equity, and so on, or even the small cap funds. So these are the striker for your portfolio. So the second thing is that apart from having a formation that cover the entire field, the second thing that you need to make sure is that you need to change your portfolio strategy over the time. Similarly, today, if I'm the soccer team manager, I play a very strong opponent. What I will do is that I will turn to be more defensive. Instead of playing 4 defender, probably I play 5 defender. Tend to be more defensive when the opponent is very strong. When the market environment is very challenging, we see the valuation for the equity markets to be very expensive. That's where we will actually underweight equity and go overweight fixed income. Last but not least, the third thing is to replace players. I think we always have this question for our clients to ask us, if they invested into a fund that couldn't perform for the past 5 years, should they continue to hold on or should they sell the funds and buy another fund? Try to imagine today, just imagine yourself as a soccer team manager. If you have a striker that cannot score any goal in the past 5 years, will you continue to keep the striker in the team and pay him the salary? I think the answer is very straightforward. The answer is no, because I could potentially source a better striker out there to replace the current underperforming striker. So similarly to managing a portfolio, if you have a fund that couldn't perform well, continue to underperform the benchmark, continue to underperform the peers, what we should do is actually to find a better funds to replace it. Please do not hesitate to replace underperforming funds in the portfolio. Yeah, and I think with that, I almost come to the end of my sharing today. So just one final slide about to sum everything up, key takeaways of our today's sharing sessions. I think the first thing is that I want to highlight to all investors and to reiterate this thing. Please do not simply chase after the best performing funds and come with the expectation that this fund can outperform, can continue to perform as how it did in the past. Bear in mind one thing, that when it comes to constructing your portfolio, when it comes to deciding which funds to buy for yourself into your portfolio, there's a few steps that you need to do. Just now I've shared with you the inter-asset allocation, the intra-asset allocation, and when it comes to fund selection, there are also a few factors that you should consider before buying into a fund. Second thing, diversification is very important. Do not put all your eggs in the same basket, because by diversifying your portfolio, not only that it helps to improve the overall portfolio resiliency, but at the same time, it also allows investors to capture the global growth opportunity. Third thing, try not to time the markets. I understand that a lot of investors, they would like to move in and out aggressively from the equity markets, but try not to do so. Try to continue stay invested in the markets, because eventually market will reward investor with great patience. And for investors who prefer a more hands-off approach in managing your wealth, try to consider FSMOne managed portfolio. Over the past 4 years, the conventional portfolio that we are managing, it delivered an annualized return ranging from 4.6% to 9.2% for the conservative and also the aggressive portfolio. And because of the systematic approach that we are implemented, that we are having to manage our portfolio, all our portfolio actually demonstrated a strong resiliency compared to the broad markets, compared to the global equity market. As you can see, just as I've shown you during the 2020 sell-off, or even during the recent global market sell-off in the month of mid-February to end of March. At this point in time, in terms of our portfolio strategy, we like Asian equity, we like emerging market equity, and particularly China equity. And at this point in time, we do have a small allocation, tactical allocation into the Asian technology segment. So early of the year, we have cut our technology, we have cut our China equity exposure given the stretch valuation. But after the recent drawdown, we have actually increased back our exposure for the technology space. And if you look at this technology fund itself, they have more than 50% of their allocation into the China technology. So technically, on the effective manner, we also have a slightly higher allocation into the China equity space. So I think with that, I actually more or less sum up the session today. If time allows, probably we will take one or two questions before we proceed to the next session. I will pass it back to Vince.
Yeah, thanks, Mr. Jason's for enlightening deep dive. I think there's sometimes for us there's a cushioning. Perhaps we can take 1 to 2 questions, Mr. Jerry. How you think?
Okay, sure, no problem. Let me look at the Zoom to see if there is any questions from the floor. Yeah. Okay. Wait, hold on. I try to log into the Zoom to see if there are any questions from the floor first. Okay. Let's see. I think we have a few questions on the from the Zoom regarding the regarding my sessions. Yeah, we have these questions asking. I'm already invested with the FSM managed portfolio. When is a good time to top up the portfolio? I would say, in order to for investor to for some of the investor, if you couldn't monitor the portfolio regularly, what you can do is actually to do regular saving plan, to do RSP, because for our portfolio we also allow RSP. But for certain investor that you will be able to have the time, you have the sufficient time to do some of your analysis and look at your portfolio regularly. What you can do is to top up the portfolio whenever there is a dip in the performance. So if you monitor your portfolio performance closely, when there is a dip in a performance for more than 2%, 3%, there will be anyway there will be a good time for you to actually top up your portfolio. Yeah. I think we have another questions asking about why we replaced our China equity fund and Malaysia equity fund in July. Can explain a little bit more. Okay. There's a recent changes that we have made to our portfolio in I think 2 weeks ago. I think we have just completed our rebalancing and the changes these few days. The reason why is because first thing first, for the China equity fund that we have in our portfolio, we found it that it consistently underperformed the benchmark and also the peers, although it delivered quite a decent returns over the past 1 and 2 years, 1 and the 2 years period. But what we noticed is that the fund consistently underperformed the peers and also the benchmark quite significantly. And the other thing you also notice that the fund actually hold quite a bit of cash holding, and given the recent weakness, it's similar to what happened to our BNB fund back in March last year. Similarly, at this point in time, we see a weakness in the China equity market, and we do expect we do have a positive view on China equity market. But I think this fund itself, they hold quite a bit of a cash holding, close to about 10%, as compared to the latest fund that we have just included into the portfolio. I think their cash holding is just only about 1+%. Both the fund, they have quite similar exposure if you look at the top holdings. But the thing we like is that the latest fund that we have included into the portfolio, they consistently deliver a very decent return. That's one thing. Second thing, with a lower cash holding, we won't actually suffer from the cash drag effect. So that's the reason why we actually replace the funds for our China equity exposure. And for Malaysia equity exposure, we make 2 changes. I think we replaced the 2 Malaysia equity fund from the portfolio. The first one is because that one of the fund, which is Kenanga Growth Fund, that we have invested since we started the portfolio, I think due to the fund size, the funds right now, they changed slightly about on their strategy. They actually increased about 25% of their exposure to allow the fund manager to invest into the foreign markets. So for us, for our Malaysia equity exposure, we just want a pure Malaysia equity fund. That's one of the reason why we remove it from the portfolio. And secondly, to a certain extent, at this point in time, we actually do think that for Malaysia equity market, we know that at this point in time, we see great pessimism for the Malaysia economy and also for the Malaysia equity market. But we have the expectation that we are ready to see some light at the end of the tunnel. So we actually replace our small cap fund with a more aggressive small cap fund, with the expectation that there could be a rebound in the Malaysia equity markets. Yeah. So these are the 2 changes that we have made to our portfolio recently regarding the China equity exposure and also Malaysia equity exposure.
Okay, thanks. Thank you so much, Mr. Jerry, for answering the questions in such a comprehensive manner. I'm sure a lot of us learned quite a bit from it. So now we'll be moving another 3 minutes breaks before the panel sections. See you all in a bit. Welcome back everyone. For the final sections on the agenda, I would like to introduce you all to the lineup of the panelists for the panel discussions today. Again, we have with us Mr. Jason Wong, Mr. Colin Lau Yu Ray, Mr. Wilson, as well as Mr. Jerry will become the moderator of the day. So in addition to the previous introductions of both Mr. Jason as well as Mr. Jerry, please allow me to take a few minutes exclusively bring you through the inspiring profile of Mr. Colin Lau as well as Mr. Wilson. Mr. Colin Lau is a senior macro analyst with the IFAS research and portfolio management teams. He is chiefly responsible for providing analysis and coverage on global markets, as well as generating the actionable market strategies. He is also part of the portfolio management committee, where he contributes his view on the global equity as well as fixed income markets. Having years of professional experience as an analyst, Mr. Colin frequently communicates the team views on the local media, including 联合早报, Money FM, as well as 96.3 SM. So he holds a bachelor degree in economics from the Singapore Management University. Next, we will have Mr. Wilson. Mr. Will is the Director of Portfolio Management and Research of IFAS Financials Hong Kong Limited. Mr. Will joined IFAS in 2007 as an analyst and is one of the pioneers of IFAS Hong Kong. He is in charge of asset allocations, funds, selections and portfolio management for the IFAS management portfolios. He also leads the regional research teams to formulate investment strategy by having ample experience within the industry. Mr. Will is a frequent speaker at practitioners' conference, and his research have been often quoted and published in the financial media. I'm sure you all are excited to hear what they have say about the market. So I will pass the floor to our host, Mr. Jerry. Mr. Jerry, the room is yours.
Hello, morning everyone.
Hi, morning.
Good morning.
Morning.
Hello, View, Colin, Jason. You all can hear me clear and loud, right?
Yes.
Yep.
All right. Okay. Hi, everyone. All our audience from Facebook, YouTube, and also Zoom. It's me again. For this session, I will be your moderators. And it's really our honor to invite our regional colleagues, View, and also Colin to participate in our panel discussion today. So for all our audience, from different channel, from Facebook, YouTube, or from Zoom, feel free to post your questions if you have anything to ask about the regional equity markets, US market, European equity market, or even China equity market, or even the local equity market, given the recent political uncertainty. If you have anything want to know about the markets and want to hear from all these experts, feel free to post your questions to from whatever channel that you are joining right now. So without further ado, maybe let me get the ball rolling by asking the first question to Will. I think this is also a very interesting question that a lot of our investors will be interested to know, as we actually see China equity market as one of the famous market for all our investors. I think right now, over the past couple of months, we have been seeing a lot of geopolitical issues, not only between US and China, but right now we are hearing about G7 and China. There's a lot of tension going on. On top of it, we have been seeing a lot of the tech giants in China, like I mentioned earlier on, Alibaba, Meituan, and also recently TT that just listed recently, also went under the investigation by the Chinese government. So with this kind of situation, we would like to hear from you whether or not should investor consider to stay invested or invest into the China equity market. If your answer is yes, or can you give us a few reasons why you think that China equity market will continue to go higher, 2 or 3 years down the road?
Yep, sure, Jerry. Thank you for your question. So, yes, Chinese stock markets actually, I mean, both onshore and offshore have been really disappointing for so far this year. Because in the local currency terms, I remember out of the 24 global major stock markets index that recover, only 2 record negative returns in the first half. Guess which? Actually, Hang Seng Tech Index, and also KLCI. So if you look at other Chinese-related stock index, they were also at the bottom, including the Hang Seng China 100 index, and also MSCI China, as well as CSI 300 index. So the poor performance of this 3 index actually shows the weakness is rather broad-based and can also be seen in A-shares, H-shares, and also ADRs. It was affected by, as you mentioned, a number of reasons, including the weaker than expected high-frequency economic data, a tightening monetary environment, which was reflected by the increasing borrowing costs and also slower monetary growth, actually. And more importantly, of course, and those policy like the anti-monopoly policy, which hits the big tax really hard. So I can say that in the US stock market, we saw quite a frequent investment style rotation throughout the first half, right? In first 2 months, like the growth stocks actually outperformed the value stocks, then value stocks started to outperform amidst the rising yield background, right? Then both value and growth stocks decreased until early June, growth stocks finally outperform again. So in each of the rotation, there are leading stocks or the leading sectors that drive the US stock market higher. But meanwhile, in China, we saw value stocks like banks can sometimes enjoy the run, when the yield actually rose. But growth stocks, I mean the big tech or those new economy stocks remain under lackluster. So market has been lack of the leaders for some time. But I think the disappointing performance in the first half doesn't really driven by the fundamentals change, which is the corporate earnings, which is good actually. In fact, though we saw some earnings downward revision, the growth over the next 2 years remain very strong. So like one of the potential inflection point is when most of the listed companies publish their interim results, which is supposed to be not to be bad. People will surely find out that they were too pessimistic previously, and reality is that the big techs are still enjoying a strong result and also the fast earnings growth. However, the stocks were oversold, so they have to come back and also embrace the tech again. So finally, we'll probably see some drivers coming back, and we like to use the Peter Lynch earnings trend chart to put earnings per shares and also share price together, and we find out that for stocks which suffer from a strong or huge drawdown from the 52-week high, their earnings trend remains very positive, which caused a clear divergence between the share price and also the earnings. So again, that was resulted by the valuation contraction triggered by the those concerns on the anti-monopoly policies and also cyber security, as well as the some macro backdrop like the rising yield. So I think this can be digested over time, and persistent improvement in the fundamentals that can help bring back the share price to where they should be. And so in the longer term, I'm not very concerned as long as this company keeping their leading position in the industry and also earnings power. So my answer is yes.
Okay, thank you, Will. I think Will had concluded that earnings and also fundamentals will actually be the key driver for the equity markets moving forward. And I think I actually agree with that, especially if you look at over the past 1 year, right? What have been driving the equity prices is really on valuation expansion. We don't well, the fundamentals and also the earnings actually deteriorate. Some of the companies actually deteriorated over the years, but recently, over the few quarters recently, what we have been seeing is that the expectation is rather low for the global equity markets. Also, with a low expectation, we are likely to see more and more earnings surprises, positive surprises for majority of the equity market, and perhaps this could be one of the strong factors to drive the equity market higher. And I think maybe we move on to some of the developed markets, for example, in US and Europe. So this question I'm going to pose to Colin. I think because of the fast vaccination rate, I think in Europe and US, we see a very faster vaccination rate as compared to the Asian markets. This region actually benefited, and it's actually reflected in the equity markets. We know that year-to-date basis, European market and also US equity market, they're actually the top performing markets, one of the top performing market. But at the current point in time, right, we're actually seeing new variants of virus causing a spike in the COVID-19 cases, and investors also start to worry about the inflationary risk, whether or not the US Federal Reserve will increase the interest rate faster than expected. So with all these risks come to the picture, Colin, how do you think about the outlook for the developed markets, for example, the US or even the European equity markets?
All right, I think, Jerry, that is a very good question to begin with. Firstly, because of how the run-up has been, especially for some of the markets, such as your US markets, and within the US market, your sectors such as your tech sector, or even your energy sector in recent times. So I would like to first look at it to answer the question where I get most often is the market due for a correction, where I think a lot of investors, be it in Singapore, and I believe in Malaysia as well, even maybe in Hong Kong, we also ask this question. So this question is something I get very often. So to tackle this question, I will first start with saying that it is hard to say for certain whether the market will correct or not. But we are definitely seeing an elevated risk of one, which is due. So there are a couple of factors which I looked at mostly. So jumping into the first factor, right? So if you look across the different equity markets, mostly the focus is on the US market. So if you look into the US market, you'll find that many of the speculative stocks are down by a lot. So I'm talking about 40, 50, or even 60% from their highs. So in this year. And these are mostly your meme stocks, your specs, and many of your non-profitable tech companies. So even your cryptocurrency as well. So altogether, right? So as that happens in the background, we are looking at a reallocation towards your defensive sectors. So defensive sectors such as your traditional defensive sectors, of course, your utilities, etc. But at the same time, also your quality stocks. So stocks with stronger earnings, less earnings volatility, and a stronger balance sheet. So all that is also happening. And at the same time, we see greater allocation towards your mega cap, your large tech sector, which at the current moment, I believe is perceived by investors to be defensive. So all that money is being reallocated from your speculative sectors or styles into all these more defensive sectors. And to me, that implies that the market breadth has actually deteriorated by quite a bit. And in fact, the markets themselves is getting a bit cautious or on the edge. So that is factor number one. And if you look at the second key thing that's really stood out to me is that the movement in asset classes following what we've seen in the recent dip in the US Treasury, that is sending a very strong and clear message that the market is getting edgy and anxious as well. So just recently, let me recap. Just recently, we saw a big slide in yield where yield went to about 1.4%. I believe it's a bit lower right now. So which that, in my view, is a signal that the market is pricing in a slower rate of change in growth. So essentially, market is pricing in that the growth might slow down in the future because of certain events such as could be an earlier than expected or higher than expected rate hike, and that actually squeezes in your growth outlook, and your rate of change of growth falls down, and that being priced into the 10-year Treasury yield. And aside from that, I believe technical factors also play a big part, where investors are heavily short on the Treasury yield, as well as position are quite extreme, entering the kind of short covering for 10-year Treasury yield. But aside from that, if you look at different asset classes that happened during the episode, we look at the US dollar, for example, and US dollar has risen during the episode, quite a lot against the emerging market currencies. And at the same time, they have the safer currencies such as your Swiss franc or even your yen has appreciated versus the USD in the same episode. So that to me is a classic sign of being flight to safety and a de-risking signal. So taken all together, right? So from the signals in the bond markets as well as signals on the currency markets, that episode really highlights to me that markets is on the edge right now, and your risk appetite has in fact dipped. So that is my second point. And moving on to, I believe, my last point. To that note, when I look at the global macro backdrop for the second half of the year, I think it is definitely more challenged than what we've seen for the rosy conditions over the past 6 to 9 months. So in fact, when I look at some of the factors that will happen or I'm expecting to happen, is that I'm thinking that the rate of change for growth is going to continue to slow down, especially in developed markets such as your Europe or even the US. So we are also likely to see a lower earning revision, because I believe the max earnings revision has kind of peaked, especially for for developed markets for the first quarter of the year, as well, and the last quarter of last year as well. So on top of that, we're also likely to see monetary tightening, which I believe will likely be signaled somewhere in September's meeting for the Fed at least, and probably some hints going to be given out in during the Jackson Hole meeting somewhere in August. So all that put together, right, I find that the markets, the factors challenging the equity markets have actually increased or will increase in the second half of the year. And that said, that is going to weigh down on developed market as well as emerging markets. And overall, there is definitely a risk where the high expectation that is being inculcated in the first half of the year is not going to be met in the second half of the year, and even beyond that. So that is also a risk that might play out as well. So back to the question, right? I do think that the factors that I mentioned, so the weaker market breadth, markets being more on the edge, more anxious, as well as the realization that this positive macro backdrop is kind of fading, and that three to me implies that we could see a higher risk of a correction. But that said, it is definitely almost impossible to put a definite answer to say whether there will be a correction or not. But I do see the risk of that happening. So that may in fact affect your developed markets, which have pretty much had a good run thus far. And a big part of it is because of their inoculation rate, as well as how they handled the COVID situation. So I hope that answers your question, and I believe that could be something that to keep in mind or keep in view for investors when they look forward to the second half of the year or even beyond that.
All right, thanks, Colin. So can I summarize your answer as in, for the second half of this year, the risk is definitely higher for developed market equities. That's one thing. Second thing is that investor probably shouldn't expect the strong returns in the first half to repeat in the second half. Can I say so?
Yes, definitely.
All right. Thanks, Colin. Okay, before I move on to ask Jason a little bit on the local equity markets, right? We do have a questions from Zoom here, asking regarding the recommended funds from funds FSMOne. So the question to Jason is that, do you recommend switching from the previous to the current recommended fund? One example quoted is that, for example, for Malaysia equity, I think the year before our recommended fund is actually Kenanga Growth Fund. Do you recommend investor to switch from Kenanga Growth to the recent CAF Tactical Fund? So if yes, what is the reason? And if no, what is the reason?
Okay, thanks for the question. I think we get that question a lot. In terms of recommended funds that we have recommended in the past, dropping down from the list does not mean that the fund is bad. It's still a good fund. Okay, firstly, in terms of whether or not you want to change or not, you have to look at your entire portfolio ultimately. So if, let's say, you look at the portfolio positioning of the funds, is it suited to what your strategy? Okay, in terms of overall portfolio, do you prefer something more dividend oriented or value oriented, or something more growth oriented, this kind of thing, before you make the changes? So for us, why we change some of the Malaysia funds, other than the scoring also, because like Kenanga Growth Fund, they changed their mandate. Previously they were 100% in Malaysia, then they changed their mandate to allow up to a certain amount, 25% I believe, into Asian equities. So I think for us it doesn't give the full Malaysia equity exposure anymore, and we have switched that fund because we don't have a Malaysia focus category for recommended fund. Therefore we switched the fund for that recommended fund. It doesn't mean that the fund is that bad. Okay, and it doesn't mean that the fund is that bad for you to drop it out. You can still keep it if you think that it will still continue. You're happy with the fund performance in the past, and you think that it can still perform in the future.
Okay, thanks, Jason. Another questions to you, I think, regarding the local equity markets. Like what Will had shared just now, KLCI was was the worst performing market on a year-to-date basis. So if you look at Malaysia equity markets, this year itself, we have been affected by several factors. First we have the increasing COVID-19 cases. Then the economy actually went into a few lockdowns before the recent EMCO in Selangor and also in KL State. And with that, together with the political uncertainty that we are seeing recently over the past couple of weeks, we have been hearing a lot of noises from the political fronts. So, Jason, maybe I think the audience would like to hear from you that what's your view on Malaysia equity market? Should they position into Malaysia equity market, or should we completely ignore the local equity market, just stay away from Malaysia equity market and invest into the rest of the global equity markets?
Yeah, sure. Overall, we are neutral on Malaysia. We have a 2.5 star rating for the market, but we do see certain pockets of opportunity, which actually a lot of fund managers can actually generate alpha. As you can see, even though Malaysia KLCI is down this year, but a lot of Malaysian funds are actually producing decent positive return. This is the alpha that they have generated. This is done by picking stock selection or certain sectors that they are expected to do well. So within Malaysia, although we are neutral overall, we think that the growth opportunity for small cap is greater than large cap. Investors can consider that. And within sectors, there are a few sectors that we think will do well going forward. For example, like financial sector. Okay, currently they've been dragged down, obviously for obvious reasons like political reason and lockdowns, and also perhaps the negative sentiment created by the moratorium that was recently announced. But overall, banks are still very profitable. Okay, if you look at the numbers, and last year they had a dip in terms of the NIM, the net interest margin. Okay, because of increasing. Actually, in terms of impaired loans, it didn't spike as expected. They actually proactively increased provisions, okay, which affected their profits. But in terms of non-performing loans, impaired loans, it didn't spike as expected, as badly, possibly due to the moratoriums that were announced last year. And this year, the moratorium could actually help them manage this NPL also. Then in terms of the NIM, last year it was affected by the moratorium as well because of modification losses. But this year we noted that this time around the moratorium is slightly different in the sense that the banks, they do not have to in last year they waived the interest for certain fixed interest higher purchase loans, but this year they didn't need to waive. Okay, this will act, and in addition, this year is an opt-in basis. Last year it was a blanket moratorium where people who didn't want the moratorium could opt out. They needed to apply to opt out. But this year, if you want the moratorium, you have to opt in. You have to apply for it. So we think because of these two factors, the take-up rate will be much lesser than last year. So the impact in terms of modification losses will be lower. The impact to NIM will be lower. Okay, that will be quite marginal. And in fact, if you look at the first quarter this year, the NIM for a lot of banks, they have already recovered. Yeah, the net interest margin have already recovered, and some even did better than before the pandemic because of that lower cost of funds. In fact, so banks we think are still very profitable, and they're quite undervalued in terms of price to book ratio. They're trading, some are trading even below book value. Okay, then in other sectors that we like tech sector. Okay, I believe if you've been following us, we like the semiconductor space. Okay, so Malaysian tech sector are dominated by semiconductor players. Okay, 10 out of the top 11 companies in the Bursa Tech Index are related to semiconductor value chain. Okay, and we think that the growth in semiconductor demand globally will actually boost the company's earnings for all these semiconductor players. At least because we think that this is a secular trend for the next 10 years, definitely the players in this space will benefit for the next decade. Yeah.
Okay, thank you, Jason. So if I were to invest into Malaysia equity fund, probably I will actually need to look into the sector allocation of the funds to look for funds that slightly with a higher allocation into financial and also technology sector, with the reason that Jason have just explained. Potentially these are the sector to actually outperform. And we move on to some other questions from the Zoom side. Maybe there's a questions to Colleen. I think just now you shared about the developed markets, and this investor is actually asking, US market is actually doing very well at this moment. Since we do not need to time the markets to go in, so can we go into the US equity market right now, or should we wait for a correction? Because what goes up must come down, right? Yeah, I think the question is to Colleen.
Right. Yeah, that is a good consideration to begin with. Yeah, and to some extent, it's true that what goes up must come down, right? Yeah, and so to answer that question, yeah, definitely. In-house view on the US is a 2.5 star right now. It's neutral, but it doesn't mean that you shouldn't go in, and you should avoid until a correction comes in. Yeah, but what we advocate to do is instead, since the US market is very big, it's pretty plenty to choose from. There's a lot of different opportunities, like what Jason mentioned just now. There's opportunities, even though you might have certain view on certain markets. And just within the US market itself, what we like right now is definitely the large cap companies or the large cap stocks. So within that universe, of course, if there is certainly higher opportunities versus the, say, small cap plays or even other styles or the sectors. So I'll first begin to talk about the risks first before talking about the benefits. So I'll do it in the opposite way. So talking about some of the risks, firstly is definitely that these large cap stocks have a wider valuation dispersion. So the valuation for a lot of these companies are in fact higher because it is skewed by a lot of these your mega cap tech names, and those tend to skew the valuation higher, and therefore, if we are expecting a de-rating, then it puts this large cap at some handicap, definitely. But with that said, I think the risk reward definitely skewed into the reward side when it comes to the large cap companies. So I'm now going to talk about some of the benefits, which is the reward side. So in the large cap company right now, a lot of this mega cap or even your large cap companies are seen by defensive sector by investors. So during times where we've seen, like I mentioned earlier, when yields come down, when the market rotate away from your reflation, a lot of the flows are generally being directed to these large cap companies. And in fact, I think a big part of them accounts for a large, I believe it's about 60 to 70% of the increase that we've seen since the yield drawdown episode. So all these large cap companies actually accounted for a lot of the flows lately. And that tells me one thing. That tells me that investors are seeing them as a more defensive play. If anything goes wrong, I'll put my money in those. If anything goes wrong, I'll put my money in those. And that dynamic itself is certainly not going to change in the near term, at least in my point of view. So despite we might see that being wavered if, say, inflation fears goes to the upside, or certain economic fears come in. But at least over the near term to intermediate term picture, I see that dynamic of it being seen as a defensive sector, not changing anytime soon. And that itself is also one big part of why we favor that. And aside from that, if you look at some of the earnings growth for this sector, those are typically the secular sector. So they have strong earnings growth, especially on the longer term basis, or if you spread out on a 10-year average basis, or even longer than that. And if you compare them against some of the smaller cap companies which are levered to the economic momentum, you'll find that, okay, these small cap companies might see tremendous earnings growth, especially during economic rebound, the period which is in early part of the business cycle, So those tend to last very shortly, maybe the first or second recovery year, because of base effect. Those it's hard to continue to sustain that kind of earnings growth and earnings growth momentum for this small cap play. So where the large cap trumps, or where the large cap comes in, is they're able to provide a stronger and longer term earnings growth as well as earnings revision, and that itself is a sign of having a stronger fundamentals as compared to some of these smaller cap companies which are levered to the economic momentum. So the fundamental side, we see that we still prefer a large cap. And also to the third point, I think if we look at inflation being possibly skewed to the upside, right, we would ideally want to be invested into a company that has pricing power and is able to pass that kind of costs onto investors and still be able to make money at the end of the day. So we think a lot of these companies, or this mega cap to large cap companies, definitely have that kind of ability to do so and to keep costs low. So essentially what I'm trying to say is they have that quality aspect, that the ability to, or the pricing power, as well as the stronger fundamental, stronger balance sheet to guide them and help them to able to perform well in such a scenario. And on the contrary, we do not think that the small caps are able to do it or are able to withstand a longer term period of a sustained inflation, or even a shock to the economy. Yeah, because of just how levered they are to the economy as well as inflation expectation. And with that said, those are my 3 points of why we see the benefits and the rewards of being in the large cap. And overall, the reward versus risk itself is skewed towards the reward for large cap. And definitely, if we were to think about whether to go into US now, what you're saying is right. We shouldn't wait, but instead look at different opportunities. And for us, we definitely advocate for US large cap. And I hope that answers your question.
All right, thanks, Colin. I think if I may add on a little bit, a lot of investors, when they come to investing, right, they look at 2 months, 3 months, or 2 weeks, 3 weeks down the road. If you're looking at 2 weeks, 3 weeks, no one can tell you what's going to happen to the markets. But if you look beyond 3 years and 5 years, if I have an investment horizon of 3 years to 5 years, I don't really have to worry whether or not next week or the week after US equity market going to go up now. what I know is that fundamentals is still there, is still strong. Corporate earnings is still actually growing, and like what Corinne has just shared, the big caps actually have a higher potential to actually continue to outperform. That's where I actually focus on. You need to put your focus on the right place, not just putting it at the 2 to 3 weeks or 2 to 3 months kind of a perspective. Yeah. So I hope we actually answered the question from the investor. And I think we talked quite a bit on equity markets, the overall equity markets. So we have these questions coming from Zoom side, asking about what is the role of a fixed income fund in our portfolio. So maybe I can get Will to share a little bit when it comes to doing the asset allocation for the portfolio. What do you see the role of a fixed income fund in a portfolio? That's one thing. The first question. The second thing is that I think so probably I get Will to answer the first question first before I continue the second one.
Yeah, so I think fixed income is always an important tool for us to build a more balanced and diversified portfolio. We always say that diversification can be achieved in several ways. One way is to diversify between the assets, which is equity, fixed income, and also some may considering alternative investment or some other asset class like commodities, including gold. Another way is to do it through the geographical diversification. And also the third way is through the product, like you can't put too many percentage on a single fund or a specific funds. That could be too much active risks imposed into your portfolio. So when it comes to the asset diversification, of course, you have to, the best way is always to put it simple between equity and the fixed income. That would be enough. That would be enough to drive down the correlations of your portfolio, as well as to make it I mean, some of the stats like the Sharpe ratio look much more better. So how would you do the asset allocation through equity and fixed income? You know, when it comes to fixed income, it has so many different classes, right? Our approach is to simply separate into the safer bond portions, which mainly composed by those higher graded but lower yield bond fixed income category, mainly the global bond fund or the Asian investment grade bond. So these two categories generally got a relatively lower yield, but on the other hand, they will offer much better cushion or the downside protection. But on the other hand, you also don't want to sacrifice your potential return, right? You want to achieve potential higher yield. So this part we will try to allocate some portions into the higher yield fixed income category, including the US high yield category, Asian high yield, and also emerging market bond funds. So through these two combination, I think we can balance both yield consideration as well as the downside protection and merge it together with the equity portion, so we can enhance the portfolio overall Sharpe ratio and also downside protection, as well as the more better risk adjusted return angle. Yep.
Okay, thank you, Will. I think the second question is regarding the China bond markets. I think in our platform in Malaysia, we do have a China bond funds. And I think the client is mentioning that the China bond fund delivering 6+% this year. I think the part of the performance is actually driven by the ringgit depreciation and also the appreciation in renminbi. Yeah, but what's your view on the China bond market moving forward, and what do you see that how's a China bond funds can help investors to diversify their overall portfolio?
Actually, I'm not too optimistic over the China bond in a rather short term or at least 1 year, because I would like to go through it in two parts. One part is, of course, the yield environment. Actually, it is on a downtrend, especially after the PBOC to decide to surprisingly lower the triple R, the required reserve ratio. I will talk about in this angle. Another angle is, of course, the RMB, the RMB trend, the currency appreciation. We are no longer able to talk about this because PBOC stated very clearly it will do everything it takes to try to put it back to the more two-way volatility. So these two parts will be the major components of the China bond, I believe. But first of all, for the triple R, I don't think it is I mean, the recent cuts in the triple R, I don't think it is a policy response to the economic slowdown. So it is true that over the past few months, China economic data has been slowing, and also missed for some of the key figures. They actually missed the expectation, but it is not as bad as the situation that at least such a powerful monetary policy. Be reminded that triple R cuts won't change the monetary base. It will only release the regulatory reserve, or put it in another way, it will boost the money multiplier effect, which is regarded as a very influential policy on the liquidity side. So also be reminded that the triple R cuts this time round is not a targeted run. It's not a target triple R cut. It is a full triple R cut in which large and mid to small sized bands can be applied. So instead of only rural commercial or the city commercial bands to be can enjoy for the target triple R cut. So I don't think the economy is so bad that it is such a powerful policy. The underlying reason is probably that, as stated by the PBOC, they want to help the SMEs to fight against the rising cost push inflation. Also, the cuts can help finance the national key projects like green energy, carbon neutrality, which is always emphasized by the presidency. And also the technology, which is expected to be the chip development. Another reason is that I believe it is a game theory between the US and China monetary policy. A large part of the China liquidities is from its fund outstanding from foreign exchange. What is fund outstanding from foreign exchange? So it is actually due to the capital control. PBOC absorbs all the foreign currency, and in return, it will exchange with RMB. So that this exchanged RMB is called funds outstanding from foreign currency, so which is a very important part of the monetary base. So in October 2014, when the US Federal Reserve decided to end its quantitative easing, and also in December 2015, the Fed raised its interest rate. Okay, actually, even earlier than October 2014, China had continued to face a huge capital outflow pressure, which caused a gap in the liquidity. So how did PBOC respond? They actually cut rate 5 times, and also cut triple R 5 times in 2015 in order to fully back the support the liquidity loss in the decreasing funds outstanding for foreign exchange. So when the US tightening its monetary policy, many EM countries actually will end up follow, cause US dollar and US interest rate as always the cost of the fundings in the world, and actually for most of the EM countries. But for China, they will do the opposite thing. When other countries facing a huge inflationary pressure and were trying to tighten monetary policy to respond, right? On the other hand, China will cut its triple R to boost the liquidity and also bring down the cost of the borrowing to help the SME. So many reality in China is actually against the theory we learned in economics, right? But that's what we should take note, and not just blindly follow the doctrine when it comes to China. So on the rate side, I believe it will be starting on the downtrend, especially I don't think it will be the first and the only time to cut the triple R this time round. And for the RMB, right, RMB will appreciate over time in the longer term based on our house views. And we actually expect this USD CNY rate to hit 6.3 this year, which was once very close to our target. But now there are more uncertainty, I believe, and expected to be more drastic two-way volatilities. Also, it always been the trade-off between the dollar and the RMB. RMB was once in uptrend since mid of May till 1st of June, after the Federal Reserve insists on their actually considering they don't consider rate hike and quitting QE in the near term. So the yield between China and US was widening. Then we saw some hot money flowing in and making the USD CNY rate appreciate towards 6.35, which was very close to our target. But since June, we have seen that the PBOC taken many proactive and also aggressive moves to stem the RMB from appreciation. The first one is to raise the foreign exchange required reserve ratio to reduce the onshore foreign currency to make the RMB to try to make the RMB to depreciate. The second thing is to lower the CNY mid price. And the third thing is the strongest verbal intervention in recent years. Those official media even warned that a high probability of the currency depreciation in the second half of this year, which we never heard it before in recent years. Normally, they just say that be expected a widening two ways volatility for RMB, not depreciation, right? So from there, you can expect that the Chinese central banks will try actively to reframe their currency to back to the appreciation territory. So not to mention about the potential further triple outcast impacts on the currency in the future. So from this angle, I think over a long term we still see RMB to appreciate. But in the shorter term, I would expect that the government and actually the central bank don't want the currency to rise too fast and too much. They will try to balance some of the consideration, I believe, from the USI. So based on the more liquidity and also the willingness to not to see the rising currency. So which these two factors together will be quite adverse to the China bond.
Okay, thanks, Phil. Since China bond is a bit slightly risky at this point in time. Then back to home, I think there's a few questions to ask Jason regarding the local bond markets. I think the first question is regarding the recommendation that Jason has just put up just now during your presentation to recommend a low-rated bond. This investor is actually asking, so if at this point in time to invest into a low-rated bond, is it more risky to that compared to the AAA bond? So of course the risk will be higher, but what are the opportunities that, Jason, are you seeing within a low rated bond at this point in time?
Okay, so I think for Malaysian bond funds, if you invest in bond fund that's pretty decent size, such as some of our recommended funds, they would be diversifying into various different issuers, different bond papers. So for you, the risk is already diversified. So on the other hand, they'll be investing into different segments as well, different credit rating, the higher grade one, the lower rate one. So I think for your investors, is already investing a diversified bond portfolio. The fund managers who have done their credit analysis on the individual issuers, I think that there isn't much to be too worried about. Okay, let the fund manager do their jobs and pick the right bonds and the right credit rating that they think is worth it. Then on the other hand, what I mentioned just now is I'm looking at a broader sector. Okay, the higher grade bonds the spread seem to be very tight compared to the benchmark MGS. Okay, whereas the lower grade ones like single A and below, okay, it seems like the spread is quite big. Okay, I think there's a structural reason behind this because a lot of mandates, investment mandates, a lot of fund mandates, they require to invest only in high grade bonds, high like AAA, AA, minimum AA3. So once you go above that, right, go below that, right, that means there's less money chasing after the same thing. There's a lot of money chasing after the high grade one, which caused the spread to become so tight, so narrow. So which I think is too many things chasing one thing, which push up the price. That is not as worth anymore. Whereas for the lower grade one, the spread are bigger because there's less money chasing that. So for investors, the lower grade ones are giving better yield pickup. The spreads are big. It can help to cushion your portfolio against any interest rate movements, interest rate volatility. Okay, which came to the point just now lah. I hope that answered the question.
Okay, thanks, Jason. The other questions regarding Malaysia bond as well. I think the question is asking about the recent political instability in Malaysia. Will this affect the government bond? And the other question is that do you expect another bond sell off? Not to say sell off, but I think this corrected for quite a bit, but not really a sell off. But do you expect another correction in the local bond markets for the second half of this year?
Okay, so I think what happened in the end of first quarter where we saw a MGS yield spike is more or less a spillover from what happened globally. So as you know, the US Treasury yields is spiked because of inflation concern, and it spilled over to Malaysia. Malaysia bond yield started to come back up. Okay, but I think at this level is quite attractive already. It's already above or same level as pre-pandemic level before whatever Bank Negara rate cuts. And we think that the downside for these bonds are very much less, okay, because it has already gone up so much. The yields have already gone up so much. The prices already gone down so much. The downside risk for the prices going even lower is lesser lah. So the entry point is quite attractive right now. Then in terms of political uncertainty, I think more or less is already priced in also. I think recently, just last month, I think we saw the first foreign outflow from Malaysia MGS, okay, where in the previous 18 months prior to that, we had seen 18 consecutive months of inflow. So I think people are starting to price in a bit of the political risk already, but we didn't see a real spike in the yields, even though there's an outflow. So in other words, there's probably demand also from local institutions who are picking up these bonds at good yields. Then because you're getting pre-pandemic level yields when Bank Negara already cut interest rate by 175 basis points. Yeah.
Yep.
In other words, they're already pricing in a lot of all these potential rate hikes in the future. So I think the downside risk is much less already.
Okay, thanks, Jason. Also, if I may to add on a little bit, if you look at the local bond market, historically it tends to be relatively stable as compared to the global bond or the foreign bond. One of the key reasons is also like what Jason had mentioned just now. We see quite a bit of institutional player buying into the local bond and supporting the local bond. Not to mention about the local pension fund. If you look beyond local pension fund, we have the insurance company that they have some requirements to hold certain exposure in MGS, those safer bonds. So with the current yield increasing to an attractive level, it's a no-brainer for them to hold on to some of these bond papers since it's a requirement for some of the insurance companies. So that's why even with increasing political uncertainty, I think the downside risk to the local bond market is relatively limited at this point in time. Yeah. And
banks, in addition, right? Banks also buy MGS for their books, because they are the most liquid assets that, in case they need any capital, they just buy and sell the bonds. Yeah. So for banks, they need all this MGS as part of their assets. So therefore, they are also buyers of these bonds. Yeah.
Okay, thanks, Jason. If we move on from the local bond markets, right? We move to our neighbor, Singapore. Colin, since you are from Singapore, can you share with us a little bit on the overall equity outlook for the Singapore equity markets?
Yeah, sure. So maybe I'll start off by sharing the kind of economic climate that we have been lately. So I guess you guys also probably heard the news that we recently went through another phase of restriction. So we have quite an extended period of restriction, about a month or so. Then right now, the restriction has been eased, and again, latest news comes in that there will be some restrictions here and there because of a recent spike in cases. So as you can see, the overall message I'm trying to say is, it's not this thing comes and go. So it comes and go and it comes back again. So what we see is this is a delaying Singapore's recovery, which we've seen on the first quarter. It's been quite spectacular from some of the numbers out there. So export growth, which is a significant driver of Singapore's GDP, over 100%. So export growth itself has been really strong lately, even during the period where I think there's a spike in cases all over Asia. So export growth has continued to be very strong throughout, and that is largely being kept up by the electronic sector and some of the chemicals sector. And on top of that, you look at your manufacturing PMI, your PMIs, in fact, and your industrial production numbers as well. There's been relatively strong, and those are painting the same message as your export numbers, essentially telling us that the external sectors for Singapore, the sectors that are doing all this trading and exports are in a very good position. And so what I'm trying to say is, when all this COVID restrictions hits, it definitely puts a pause on the domestic demand and domestic activity. But that said, the buffer kind of falls onto your export sector, your external sectors, so to speak. So those are the sectors which contributes to the most to growth, are still holding Singapore's growth higher, and that itself is able to buffer for some of this economic halt from the restrictions. And on top of that, if you look at the vaccination rate of Singapore, I think it is quite commendable. So for me myself, I'm already vaccinated twice already, but the majority of the population has been vaccinated faster than me. So I would say that the vaccination rate or inoculation rate has been quite good, and in fact better than what people expected initially. So that actually helps in sort of troubleshooting for that kind of restriction period, where within the restriction period there is still some allowance for people who are vaccinated to have some mobility. They are able to go out and enjoy certain stuff. So the inoculation rate essentially is also helping us to temper with the effects of your restriction. So with that said, if I were to look beyond that, I will expect the external sectors to continue improving and throughout most of this year, and that is being helped by electronics and to some parts itself also your chemical sectors. And on top of that, the inoculation rate to prevent a more drastic kind of lockdown measures from impacting the economy. So the macro backdrop itself, the growth outlook for Singapore has in fact improved quite a bit as compared to last year. So I think last year was so much in the worst case, in so much worse than what we see this year, and momentum has been met last year, but we are seeing momentum kind of starting to restart, but at a slower pace right now. But eventually, 6 months out, 1 year out, we are also looking at something more positive, and growth will continue to be there because of those two factors. So the external sector's recovery will be faster than domestic sector, but eventually those two will match up in about 6 months to 1 year's time. So the backdrop is good for Singapore in terms of your macro. So when you look at the equity market itself, I think Singapore's equity market has sort of pricing that in earlier on in the second quarter as well. We see quite a good run up for Singapore equities in the second quarter, especially some of the local stocks that is being so-called touted to benefit from that reopening measure. Of course, we recently went through another lockdown, but I think that has been priced into some of these stocks. And aside from that, the banking sector itself, which comprises a large part, I believe, 40-50% of the STI itself, has improved tremendously. So be it based on price or even based on fundamentals. And our house view on the local banks itself is, we are still very positive on the local banks, because we see the earnings contribution for NIM or net interest margin to continue to improve over the medium to longer term picture. And also a big part of the earnings is now coming from your interest income, your fee-based income from some of this asset under management or some of these other initiatives. So that itself is driving a lot of income from more of starting to become more of a structural and a longer term trend. So if to look at the longer term outlook, a year out, 2 years out, I think the view is still very positive from the financial sector in Singapore, and therefore that can be a bit rough for Singapore equities moving ahead. So with that said, if you look at Singapore equities right now, we do see a very good so we're in good place when it comes to the macroeconomic outlook. Also, we're in quite a decent place from the equity market perspective. So the thing to note here is that I believe that equity market has priced in some of this reopening measures or reopening positivity relatively ahead. So we might see some fatigue or some pause in the very near term at least. But over a longer term picture, if you look at the valuation level itself, is still relatively cheap as compared to our fair PE, and that itself is signaling there is some room for mean reversion and therefore some room for equity upside in at least in the intermediate term to a longer term picture. So I would say that put all things together, the Singapore equities itself is definitely better than before, but we do expect in at least in the very near term some of this recent negativity will continue to cause some fatigue in the equity market. But beyond that, essentially, if you look at 6 months or a year or 2 year down the road, I think the Singapore equity picture, the outlook itself is relatively positive. Yeah.
All right, thank you, Kerwin. I think speaking on the financial sector, right? I think as a house, we're actually quite positive on the global financial sector. Being one of the sector that been so sensitive to global growth, right? With the expectation of a reopening in some of the country in Asians, and also the faster than expected vaccination rate in certain countries. I think when economic growth pick up, eventually global financial sector will be one of the sector to really to benefit from it. And if you move on to some other questions, right? I think just now Will mentioned about gold can be one of the asset class to diversify, the risk of the overall portfolio. So we have one question asking about, is there any comments on the outlook for gold moving forward? So Will, probably you have anything to share about on this space?
I think in the shorter term trend, I'm actually not so optimistic. Because I think the most favorable macro backdrop has actually passed, and the beneficiaries this time round is not gold. To enjoy the low interest rate environment and also massive liquidity boosted by the central banks, and also the unwillingness to raise the interest rate by the central bank. On the other hand, the inflation is rising. Sounds so familiar, right? Because we have actually witnessed the same thing back to 2010 to 2012. At that point of time, we have the same macro backdrop. So gold really enjoyed the rally. But this time around, gold performance has been really disappointing. The capital actually flow into Bitcoin rather than the gold. So really disappointing, but no choice. And I think the most favorable backdrop for gold has already passed. And as times move on, we're closing to the end of this year. I believe that, as Colin mentioned, in November, as early as in November, the Federal Reserve may probably announce some tapering measures. Of course, not to imagine the rate hike first. We have to quit the QE. The first step is to tapering. The second step is the end of the QE. The third will be the rate hike. But of course, when it comes to tapering, it will definitely raising people's rate hike expectations. So that will definitely quite adversely impact on the gold performance. But of course, if we talk about long term and to do some asset class allocation to diversify your portfolio risk, from this angle, gold is always you're always welcome to put it into your portfolio.
Okay, thanks, Will. I think there's very interesting questions here from the YouTube channel. This client is asking about, what's your view in regarding the CNBC news reporters saying that markets is going to experience a bit sell-off? I think it's not about correction, but it's mentioning about bit sell-off and also probably a crash. Yeah. So what maybe we can get Jason to share a little bit. What do you think about your view regarding the comment saying that there could be a big sell-off or a crash in the global equity markets?
Okay, I think it's quite unlikely, okay, to see a big sell-off like last year what we did, because you need a sort of like a big black swan event to trigger that kind of sell-off and cause a lot of, I would say, domino effect, okay, to see that kind of sell-off anymore. Which last year we saw a lot of unprecedented events happen, like oil prices turning negative. That was unprecedented. Then you see there was a point that S&P 500 were dropping like 10% per day for a time. So I don't think we're going to see that kind of sell-off anymore, because that the black swan event that we saw last year is unlikely to happen again. People have already sort of like adjusted to that. And in terms of macro backdrop, it's much more positive right now compared to last year when we saw the COVID pandemic causing a lot of trouble. Okay. Historically, I think if you want to wait for a sell-off before you go into the market, you're going to wait a lot of times. You might miss out a lot of rally before that happens. So I think our view is that the positive macro backdrop is positive for equities. If you want to wait for a sell-off, you're going to miss out on a lot of rallies.
Okay, thanks, Jason. Also, if I may add on a little bit, right? Regarding all these kind of comments regarding the sell-off or crash in the equity market, if you're aware, in the year of 2017, it appeared multiple times. Where back then people are saying that it's the number of 7, 2007, 1997, and 2017. So back in 2017, we also hear a lot of news. We see a lot of reports saying that there could be a big sell-off in that particular year. But what happened subsequently is that market actually rallied until I think the beginning of 2018, where people are very optimistic. A lot of people are buying the equity market. That's where when Fed started to taper, and that's where equity market started to experience some correction. So the message that I'm trying to bring out here is that when market are expecting a sell-off, when everyone is cautioned, it's actually reminding you that you got to be aware of a sell-off, you got to be aware of a crash. Crash won't happen. So the big sell-off won't happen, because when people are aware of it and when people are prepared for the sell-off, it won't happen, because like what Jason just mentioned, in order for a big crash or a sell-off, it got to be triggered by some of these black swan events, some of these unexpected events. But when everyone is expecting that to happen, very likely that it won't happen. Yeah, I think we are also
I would like to add a bit more. Yeah.
Okay.
So in Malaysia, right, we used to have a very famous fund manager. I'm not going to name him, okay, but he has been pessimistic on the Malaysia market for n number of years, okay. So therefore, his portfolio is always holding cash, always in those very defensive stock, because he always said market gonna crash, market gonna crash. So he already missed out on a lot of market rally because of that. And I'm not gonna name the fund the fund or the fund manager, but there's such a thing happening in Malaysia. He used to be very famous. Yeah.
Yeah, I think back to it's actually similar to what I've shared earlier. Market timing is extremely difficult. If you just miss out a few days of best return within the past couple of years, right, you potentially the total return will be half or even or went into a negative territory. So instead of timing the market, expecting when will be the next crash, when will be the next big sell off, I think what's more important is really to understand the fundamental and also to stay invested in the market. Like I mentioned, markets always rewards investor with good patience. Yeah. So I think like I said, we actually closed the end. Before we end this session, maybe we get every panelist here to share with us what do you think is the key risk that keep you awake at the night. And to close this panel discussion session, maybe every one of you also share one advice to the investor if they would like to stay invested in the market, or they are new to investment, they would like to build or construct their portfolio. What is your advice to them, and what is the key risk that they should be mindful of? Maybe you can start off from Will first.
Yeah, I think my advice is investors should always know the underlying factor that drive their investment decision. Always remember this underlying factors, because from time to time you will always hear so many different noises that could affect your and change your mind, which will make you sometimes feeling lost. But always remember the underlying the factors that drive you to make such investment decision. When the facts change, of course you have to change, but when the noise change, you shouldn't be changed. So that's my advice. But in terms of the risks, the key risk I would try to link up with the rest of this year. One of the key risks that could affect the both equity and fixed income markets will still be the rising yield risk, because we have already seen this risk starting from actually fourth quarter of last year, and still remember the drawdown in September, October last year in the US stock market. If not more about the drawdown we witnessed in February to March this year, that was actually driven by the valuation contraction as a result by the rising yield rather than the fundamental change. So interest rate is highly inversely correlated with the valuation, and when the yield rise of valuation will be suppressed, right? So in a normal period or back to the last early to mid expansionary stage, it didn't pose much negative impacts because on the one hand, valuation concern can be offset by the fundamentals improvement. But on the other hand, the valuation at that point of time were far below to the current valuation level, which is at the high range of the historical level. So I always say that a bull market will not be kicked off on the foundation of such a high valuation level. So we need a volatile market or time or improving and actually strong fundamental to digest such high valuation. So on the other hand, you once dropped below 1.3% in June. Can it be lower? I'm not too sure because it was down due to some technical reasons, because the U.S. Treasury is going to meet the debt ceiling requirement by end of this month. So they keep cutting expense while proposing issuing additional treasuries. So a massive amount of liquidity have been rushing from Treasury TGA account to other instruments like we have seen the Fed keep doing reverse repo to absorb the liquidity. On the other hand, some money actually flow into the U.S. Treasury, driving the yield downwards consistently. But the story could end by end of this month. Another angle the will is that U.S. Treasury, which is the nominal yield, can be decomposed into TIPS yield, the inflation-linked bond yield, which is the real yield. And the difference between the real yield and the nominal yield is the inflation expectation. We call it break-even rate. So real yield once climbed to 0% in the first quarter of this year when the inflation expectation actually keeping flat as people actually speculating the yield on a more downward pressure. So that was mainly driven by the speculative force. But inflation expectation actually rose in the whole second quarter. So even if you don't expect a hyperinflation, but what about a 2%, 2.5% to 3% core CPI actually means the inflation expectation together with a minus 0.5% real yield were enough to put the treasury yield, the nominal yield, back to 2%. So it is very easy to push the US Treasury yield back to 1.8 or even higher level. So just to remind that this rising yield could come back very easily and subspread the valuation again. But as Colin highlighted earlier, there are actually many different inflationary hedge strategy that we can play with. So yeah, don't be too worried about this.
Okay, maybe we go on with Jason before the last panelist to express his view.
Okay, so in terms of the risk that will keep me up at night, I would say I'm not afraid of any risk. Okay, there's no risk that keep me up at night because when I invest in a diversified portfolio across different geographies, different asset classes, and I know what I invest in. I invest in strong companies with strong fundamentals that, yeah, even though any risk comes, it will just like probably be a small dip, small correction, because I'll continue to hold on to that, and probably I'll add more if the sell-off actually comes. Then I also keep the portfolio within my risk appetite, my risk profile, so that I don't take too much risk, I don't over risk, and I don't over leverage, which could cause to the downfall of a lot of investors. Okay, and I have a systematic approach in terms of investing, so I'm not afraid of any risk. Just come. Okay, but in terms of what could be a risk to the markets, possibly a new variant that's even scarier right now. You've been hearing like there's alpha, beta, delta variants that are getting stronger and more more easily transmissible. Then it's also deadlier. We don't know. there could be a gamma or zeta or whatever new variant that we could see a repeat of whatever happened in 2020. We don't know yet, but that's an uncertainty over there. That's a risk over there. But in terms of the portfolio, I'm not really too concerned. Yeah, that's all.
All right, thanks. How about you, Colin?
Right. I'll start off the advice. So my advice is relatively simple. So when investors look at a security, always keep the fundamentals in view. So ultimately, the purpose of this is to have an idea of what price you should be paying for this security. So at the end of the day, do not pay something overpriced, because it's proven that over in the longer term, your longer term return will actually falls. So be rather smart about it. Keep fundamentals in view and pay a good price for what you're always buying. And so moving on to my risk. So to me, it is not my key risk is something that it has high probability instead of something that is rather severe but low probability. So with that said, my key risk is that that if you look over the past month, investors has repositioned relatively heavily in the US tech stocks. So in fact, to the point where I think position data is showing that the positioning for US tech stock is relatively stretched right now, and that leaves a lot of room for some downside risk. So should inflation data surprise to the upside, like Will said, and yield rises again, or any of that kind of trigger that drives investors away from tech stocks, you might find that the rotation out of tech stock and possibly into other sectors could possibly happen, and this is a material, in fact, a material risk, and therefore this repositioning itself can introduce a significant sell-off from the position heavy tech stocks. So that itself could be made worse, or rather is made worse by your high option volume, which we see that tech stocks accounts for the composition of option volume is highest within the tech sector. So that can make the kind of sell-off worse. So in fact, overall, that creates greater market volatility, and over time, that will ultimately trigger a possible de-risking across the different asset classes. So it might come as a bar shock for some portfolios. So when volatility goes up, the portfolio de-risk, and de-risk it. They sell off all the different kind of assets. So essentially, there is nowhere to hide, and especially this could be a likely scenario if the drawdowns are big, and drawdowns are big because it might be amplified by your option volume. So I think this can hit equity hard, especially given that equity is considered a higher risk asset, and that can be sold off at the very top. And overall, this is being made at this is much more of a reality when we look at for example, the 6 months correlation between the S&P 500 index and the US 10-year Treasury, because that kind of correlation has moved positive for the first time since 2013. And this means that when price for S&P 500 falls, the Treasury bond price falls as well. So that leaves investors little room to hide, in fact. And like I mentioned, it goes hand in hand with the kind of mass de-risking across asset classes. So so I think definitely this positive correlation can be amplified if inflation surprises to the upside. And so this mass de-risking is essentially a risk that I see has quite a decent probability of happening. But in terms of that kind of severe reaction or severe correction, I don't think it is still up there yet. So that is the key risk that I'm watching.
All right, thanks, Colin. So basically, I can summarize that the key advice to all the clients or all the investors is that first, you should really understand what you invest, understand the product itself, understand the exposure. Don't just blindly looking at performance, that the funds have delivered strong performance, then you just blindly buy into the funds. That's one thing. Second thing is to really practice diversification. If you really want to buy into a tech stock, it should keep your maximum probably 5%, 10% of your total exposure, not to the extent of 80% of my exposure are all tech. So these are key things that investors should actually take notes. And I think for some of the investors that you really want to construct your own portfolio, just now we have shared about a few strategies, a few key steps to really build your own portfolio. Start from building your inter-asset allocation, your intra-asset allocation, and all the way to the fund selection and few sectors to consider. And I think I also want to sum it up this session with one of the recommendations for investors who really prefer to a more hands-off approach in managing their wealth. Can feel free to try to log into our website and look at the managed portfolio, which actually is a all-in-one portfolio management service where we help all the investors to build, construct, and also to manage their portfolio for investor. Yeah. So I think with that, we come to the end of today's panel discussion. And thanks to Will, Collins, and also Jason for participating in our panel discussion today. Thank you so much. Thank you, everyone. And from here, I actually pass on to the MC, Vince.
Thanks, Mr. Jason, Mr. Colin, and Mr. Will, as well as Mr. Jerry for bringing us such an insightful panel discussions. And here comes to the end of our webinar. Before we leave you, do take some time to fill up the poll, which would appear now. And thank you in advance, and we appreciate your participations of these polls. So in the midst, let's recall the essence of the day. So first, we're having Mr. Jason's explain about the outlook of the Asian markets in 2021. And 2022 will be strong as well as emerging market in terms of growth, profitability, as well as valuation multiples. And next, we'll have Mr. Jerry to provide the coverage on the common mistakes made on investing, the importance of diversification, enhancing the portfolio alpha via the qualitative analysis, as well as the current portfolio exposure. And lastly, we will have the sections with insightful, fulfilling panel discussions that provides us a substantial information on the current market outlooks and how we can schedule to cope with the current market rallies. So due to the time constraints, we are much apologize if we didn't manage to answer all of the questions. But it's not a big issue. You may send your unanswered questions at the email of clienthelp.my at fundsupermarks.com, and our team will answer all of your concerns respectively and professionally. The email address will be sending in the chat box on Zoom, as well as the comment sections of the social media live streaming. So furthermore, to take advantage of our 0.5% sales charge for all recommended unit trusts until the end of the month to grow your portfolios. In addition to that, for the next 2 weeks, we will be continue on a recommended unit trust webinar with another 4 fund houses. And all of this can be watched via Zoom and YouTube. So head over to our website www.sfmone.com.my to register for the event if you haven't already done so. I would like to once again thanks every of you for joining us today. And we do hope you found the webinar beneficial and thus you will bring something home. Looking forward to meeting you all soon, and may you have a great weekend ahead.